So hey everyone, it's Mike Valtos from Order Flows, and welcome to today's presentation. It's I was just talking earlier, and it's kind of a crazy time that we're in. With the coronavirus, with all the protests going on, and a lot of people are always wondering, how is this going to affect the markets? Honestly, I talk to a lot of people. They think, well, the market should be down, right? Shouldn't the markets be trading around 2,000, yet we are, trading above 3,000 again. And, it just seems to keep going higher and higher. And if you're using order flow, you would have been on the right side of a lot of the moves. So what I'm talking about today is how to get better trading results with order flow. And, what I'll be specifically talking about is order flow market internal data. And when we talk about what it is, why it's important, and how to use that internal data to nail trades. So again, for those just really briefly that are new to a presentation by myself, my name is Michael Valtos. For the last 5 years, I've been the owner and trader at orderflows.com, which is a software and education company to help traders understand what's happening in the market. But prior to that, my professional background is I spent 8 years at JP Morgan as Vice President of Futures Trading. I spent 4 years with Cargill as a trading desk manager, 3 years at Commerzbank, the big German bank, as a licensed Eurex trader, EDF Man, the big English trading company, for 2 years as a global macro trader. I spent 3 years at Dean Witter. I was a Globex trader, trading electronic when electronic markets just started taking off in the mid 90s. And I started my career on the CME trading floor as a runner. Back in those days when there was a trading floor, that's how a lot of people got into trading, is they would come down to the trading floor, either the CME or CBOT or NYMEX, and get a job as basically the lowest level. But now you don't have that, right? Now to get a job with the trading firm, you got to have a math degree, you got to have a programming degree, preferably both, or you got to be literally a rocket scientist. But so a lot of people don't get that entrance into the trading world, and then they start going out there and trying to figuring things out for themselves on their own, and it's tough, right? So that's why I created orderflows.com. And sort of the flagship product is the Order Flows Trader, which is a software that runs on NinjaTrader. I created it in 2015, and it runs on NinjaTrader 8, and it's a volume footprint chart with 7 pre-programmed order flow indicators. And I just want you to know the charts that are used in this presentation are generated using that Order Flows Trader software. And I wrote a book I started writing it in late 2013, 2014 on trading order flow, right? And it's from this book that the orderflows.com and the software came about. But if you stick around to the end, I'll show you how you can get it for free, right? It's 150 pages. You can download it. You're not going to get sent the hard copy. Now, just a brief disclaimer before I jump in. Do understand that trading involves risk, right? An investor could potentially lose all or more than the initial investment, and risk capital is money that can be lost without jeopardizing your financial security or lifestyle. Don't think that you've got a couple $1,000s, you're going to put it in a trading account and turn it into $1 million in a month. You're not going to do that. Now, let's jump into it. So markets, specifically futures markets, but forex and stocks are the same. They trade in a two-way auction. There's a bid and there's an offer, right? And people that are sitting on the bid are what is considered passive buyers. They're letting the market come to them, right? If you're on the offer or above the current offer, you're what's considered a passive seller. Now, for a trade to happen, someone's got to cross the bid offer line. So an aggressive seller has to sell into the bid, sell to the passive buyer, or for the market to start moving higher, aggressive buyers have to start buying the offer. They have to start buying aggressively. They have to lift the offer, lift the next offer, lift the next offer. Aggressive buyers buy from passive sellers. But interpreting what you see on the dome or time and sales is like trying to drink out of a fire hose, right? There's just so much information. An order flow footprint chart takes that information and puts it into an easy to read and apply format. What you see traded on the dome is all here, but more importantly, it puts it in a format that you can make informed trading decisions from, right? So you could see, when aggressive sellers are in control, when aggressive buyers are in control, when in a bar, right, within a time period, when it shifted from all aggressive selling to all aggressive buying, right? That's information that as a trader, you want to use and apply in your trading. So after all, what good is data if you don't know what to do with it, right? So I'm going to talk about sort of the three building blocks of order flow analysis, and their delta, point of control, and imbalances. It allows you to take, the raw data, the raw Lego pieces, and build a nice house with. So just really briefly, delta is the difference between aggressive buyers and aggressive sellers in a bar. Now, delta is important is so that you know who is dominating the current market as shown in the bar, right? And again, it's the difference between the volume traded on the bid versus the volume traded on the offer, right? And delta on my software and most order flow software, the volume footprint chart goes along the bottom, right? It runs along the bottom. Some softwares will put it above or below the bar, but in general, you can see it along the bottom. And if your order flow software doesn't have delta, you should ask, why doesn't it have this information? Because you want to know, you know, is there more aggressive buying or more aggressive selling? Now, point of control is the price level in the bar with the most volume. There's no fancy mathematical formula, or calculus or anything like that. It's just simple arithmetic. The price level with the most volume is traded on the bid and traded on the offer. If that price level has the most volume, that's your point of control. Every bar has a point of control. And you can see I highlighted a few of them here, but generally, it will be highlighted with a rectangle around it. Some people like to color it other colors, but generally, when you look at it, it stands out, right? You want to know where in the bar the most volume occurred. And if you're familiar with things like volume profile, market profile, you'll understand the importance of point of control because it can act as value, in that bar, in that microstructure. Now, the third part of order flow is market imbalances, and they occur when there are more aggressive buyers than sellers or vice versa in the two-way auction. So a buying imbalance occurs when there's at least 4 times as many traders buying the offer than traders selling the bid, right? So you got to have 4 to 1. So, if the market is, 30.19 and a quarter bid at 30.19 and a half, and what traded on the bid was only 10 contracts, but 100 contracts traded on the offer, that you'd consider that a buying imbalance because there's more people buying the offer than selling the bid by a certain amount, right? And a selling imbalance is the opposite when there's at least 4 times as many traders selling the bid than traders buying the offer. And when you start seeing these develop, right, what you're looking at initially on a footprint chart is one price level, but then when you start seeing aggressive buying at the next price level, the next price level, the next price level, it's telling you that aggressive buyers are in control. And think of it this way, think of imbalance this way, right? You have a big force against a smaller force. Who do you think is going to win? The big force is going to win pretty much majority of the time. And on a footprint chart, it's going to show, in the volume, in the bar, buying imbalances are going to be blue. You can see I highlighted these with blue arrows. I didn't highlight all of them. And selling imbalances are red numbers inside the bar. I highlighted a few of the selling imbalances. So, generally, as the market rises, you see buying imbalances, right? You see aggressive buyers are lifting the best offer and looking for the next best offer. Demand is present, right? Generally, as the market falls, you see selling imbalances. You see aggressive sellers are selling into the best bid and looking for the next best bid to sell into. Why? Is because there's a lot of supply present, right? If there's a lot of supply in the market, they got to start moving it, right? They got to start lowering their offer. They got to start hitting the bid. When they can find buyers that are willing to pay a certain price, they're going to hit those bids. Then they're going to hit the next bid. They're going to hit the next bid until their supply is gone. Now, the main topic I want to talk about is market internal data. What is order flow market internal data? So earlier I talked about delta, right, which is the difference between aggressive buyers and aggressive sellers in a bar. And most order flow traders use delta in their trading, but there are further distinctions within delta, right? There are max delta, min delta, and cumulative delta, right? So it's not just the headline delta number, which is the difference at one point, but you also have max, min, and cumulative. So max delta, what that is the level at which aggressive buyers were the strongest in the bar. So meaning a max delta number of 719 tells you that at one point in the bar, there were 719 more aggressive buys than aggressive sells. Now, max delta will always be positive, and on some occasions it may be zero, which means at no point in the bar were aggressive buyers in control. Okay, min delta is the opposite of max delta. It's the level at which aggressive sellers were the strongest in the bar. Think of max delta as buying, min delta as selling. Okay, so a min delta number of minus 719 tells you that at one point in the bar, there were 719 more aggressive sellers or sells at, again, one point in the bar. Min delta will always be negative, right? That's one of the distinctions, because when you're calculating just the delta, right, you have your max delta, your min delta. Max delta is positive, min delta is going to be negative, and that's how you sort of keep the score. So min delta is always going to be negative, and on some occasions it may be zero, meaning that at no point in the bar were aggressive sellers in control. So on the volume footprint chart, right, on, like, for example, my order flows trader chart, you could put the max delta and min delta on your chart so you can see, where the strongest buying was, where the weakest or the strongest selling was. And most bars you're going to have, generally most bars you're going to have, sort of a tug of war, right? You're going to have some max delta, you're going to have some min delta. Okay, now there's going to be instances where you have some bars, like you can see right here, right? This was yesterday afternoon. As we made this new high at 29.5, there was no min delta, right? The bar before it, no min delta. It's all max delta, right? And we close somewhere near our max delta numbers. Okay, so I'm going to get into that a little bit later on how to read what's happening in the max and min delta. And the easiest way to remember why max and min delta are, or what they are, is the strongest level aggressive buyers and aggressive sellers were in a bar. Most bars will generally show both aggressive buying and aggressive selling, but there are bars where one side stands out, right? All aggressive buying or all aggressive selling. Those are the bars to pay close attention to in context of the market. Like I said, most bars are going to have some positive delta, max delta, some min delta, but there's going to be bars that have either very little min delta or zero min delta, or very little max delta or zero max delta. And when you read what's happening in the market, put it in context of where the market is trading, it can give you some nice trading. So, just quickly, for example, okay, this is the 2nd of June, which is Tuesday, and you can see how the market popped up right here, right? It just popped up from basically 62.5, all the way up to 65.5. But what preceded it, right? You had a couple of bars. You had one bar, two bars before that had zero min delta. The bar immediately before had zero min delta. But look at the max delta, 642, right? And where did the final delta close, right? It closed at 642. So it closed on its extreme buying. So I know that what was happening is, in these two bars, right, there's very little selling, even though, people are trading the bid, but aggressive sellers aren't in control at any point in this bar. And then when I see this bar just dominated by aggressive buying, zero min delta, max delta 642, final delta closing on the max number, I'm looking for the market to continue in that direction, because I know I got aggressive buyers. And the beauty is this market really hasn't started moving yet. It's not till the next bar where it opens up at 2.25, trading 2.25, 2.5, and then boom, over the next 5 minutes, basically pops up a quick 3 points. Now this is yesterday in the 10-year note futures. 10-year notes are a contract that are extremely thick, in the sense that a lot of volume trades on the bid, a lot of volume trades on the offer. It's not uncommon, as you can see here, to trade, several thousand contracts on the bid and several thousand on the offer. But look what's happening, right? This market is just going sort of sideways here in this box, okay? And you're thinking, well, yeah, it looks like it's kind of coming down. But then when you look at the internals, you look at the max delta 1, 1, 0. Right here, you got back and forth, right? This is just your average bar, right? You got 303 max delta, 407 min delta. But here, you got 1, 1, 0. And look where the min delta is, 1451. Final delta closed at 1450. Here you've got min delta of minus 3,361. Final delta minus 2953. This is that mixed bar, still negative, minus 407 min delta. We close at minus 205. And then here, minus 1039, 0 max delta. Final delta minus 1039. So you're closing on your extreme here. You're closing within one contract of your extreme here at 7 o'clock. Here you're closing about 300, 400 contracts away. But what do you see? It's mostly aggressive selling. I mean, I'll say mostly because you have this bar with a little bit of aggressive buying, but all aggressive selling, all aggressive selling, all aggressive selling. What do you think the market's going to do, right? If it can just break through this little double bottom here, we're going to drop, right? And then what happens in this next bar here, right? We trade from, the 138.22.5 area, boom, over the next 30 minutes, all the way down to new lows. Now people say, well, yeah, that's only, what is that, um, 5 points. They trade in half ticks in the 5 years. 5 years is a contract that people push through huge size. So if you're just making, 4 or 5 ticks in the 5 years, you're probably trading 10, 20, 30 contracts that you only need to make 3 or 4 ticks, on the fives. Now, cumulative delta is the running total of delta on the day. And cumulative delta can be positive, which means there's been more aggressive buying than selling, and generally the market will be higher on the day. Cumulative delta is negative. When cumulative delta is negative, it means there's been more aggressive selling up to that point, and generally the market will be lower on the day. But that's not always true. I say generally because there's times where the market has been selling off all day, and we're down negative on the day. And then the market's going to start moving up. For the market to start moving up, you're going to start seeing cumulative delta getting lesser and lesser, and it could still be down on the day, but cumulative delta is turning positive. So, there's I don't want to give you, a statement saying that cumulative delta is negative means there's, the market is lower on the day, because it's not true. Cumulative delta is dynamic. So this is the footprint chart. Cumulative delta you should have on your chart. It'll appear, on the bottom with your other delta numbers, and it's going to tell you. You can see here, right, as we hit the high of the day, right, cumulative delta is its strongest, right, which is generally how it should be. But I'm going to show you some examples where you have this divergence when the market is making new highs, but cumulative delta is getting weaker, and what that means. So every bar has a max delta, min delta, and cumulative delta is cumulative up to that point in the bar. And remember, max delta can be positive or it can be 0. Min delta is negative or it can be 0. Cumulative delta can either be positive or negative, and on rare occasions it can be 0. Okay. So why is this data important? Is because how many times have you taken a trade and immediately it went against you, right? It happens to all of us. It happens to me sometimes. I think I got the world's greatest trade set up. I get long, market goes up 1 or 2 ticks, and then immediately sells off. Well, it's what you do next, what you read next in the order flow that's going to determine whether you're going to be successful or not on the trade. So let me ask you, do you let a trade stop you out, or are you willing to get out of a bad trade early? you know, Getting out of a bad trade earlier is going to give you a smaller loss. Market internals can tell you when market conditions change. Now, I'm not saying that as soon as, the first sign of a trade not working out, you get out, because, eventually, there's going to be trades where, um, you find yourself getting out early, and then the trade goes to a winner. But what I'm saying is, when you have a reason for a trade, right? You say, I'm getting short because of this reason. But then things in the order flow change, as you start moving away from your entry, all right? Then the market is telling you, you know what? It's discounted already, your trade idea. And, chances are it's not going to work out unless you still see follow through order flow. So this is an example from Tuesday, right? Market was selling off. This is S&Ps selling off and it looks negative, right? You see it coming down here, 30, 65, 64, 63, 62, 61. Then you get in here, you start forming this base. And if you're watching what's happening in these deltas, you can see that, you know what? This market is starting to turn. So if I'm short, okay, if I'm short, then I see something happening here in the deltas, max, min, delta, and to a certain extent, cumulative delta. You know, that's my reason to cut this trade either at a small profit, a small loss, at a break even, rather than let it come all the way back up to my entry and, or my stop rather, and take a full loss on it. That's sort of one of the drawbacks of, a lot of these automated trade entry systems, all right? I don't want to get into their names, but where it just, you're going to run it on autopilot. I've got my take profit here, I've got my stop here, and it's either going to go to my take profit or it's going to stop me out. Well, at some point, right, you want to be a trader, you got to trade, you got to read what's happening in the market. So for example, right, this market's coming down, but if I'm watching the delta, I see, okay, yeah, we're here at the low, strong negative delta, minus 459, minus 199, minus 13. Okay, so I know that the aggressive selling is getting weaker. If I start looking at the internals, max delta is still 0. Okay, that's what you like to see on a market going down. Here, you start to see some buying creep in, positive 53, positive 43. More importantly, the min delta, minus 774, minus 213, minus 179. So the min delta is actually getting weaker as well. So it corresponds to what you're seeing in the final delta, but then in this nice green bar, what do you see? Min delta is -1. So it's only one contract where one, of aggressive selling in control of that bar. Max delta is 500. Right? You don't see a 500 in any of these previous bars. And we close right near our final delta number of 439. Okay, then yeah, maybe you're not convinced. You do have a bunch of buying imbalances as well going on in there, which is also bullish. And then in this next bar, what do you got? Right? Min delta 0, max delta 443, final delta 313. So, think about it. What's going on? You got aggressive selling all the way down here. Strong aggressive selling is showing up in the min delta with small max delta numbers. But then you get here and you could just see the aggressive selling petering out. Minus 774, which is strong within, minus 213, minus 179, minus 1, 0. All right. Then you start seeing the max delta growing, 515, 443, right? That's your sign that, you know what, I'm short from up here. Maybe this is time to, lighten up on my position, get out of it, or, take some profits rather than let the market just slowly grind you. Because a lot of times, people will sit here and, oh, I'll let the market, yeah, this is just a bounce and then we'll continue down. No, if you're seeing what's happening in the internals, you know that it's strong off this low. Okay, so this is yesterday. Max and min delta is going to help you see what direction we're going in the market. So, we're just sort of going sideways here, okay? Max and min delta is just kind of going back and forth, but you see it's starting to build up here, right? You see, it's 32, 85, 142. That's the max delta, 85, 11, 106, 86, 85, 70, 182. Min delta is kind of strong, minus 900, minus 400, minus 300, then it gets in here, which is kind of back and forth, minus 100, 129, 166, 54, 128, 126, 152, right? You're still putting up kind of decent min deltas, but at the same time, buying comes in, right? What's happening? Buyers are absorbing that selling that's going on until finally the selling isn't as strong as anymore, right? Earlier, it was quite strong here, right? Minus 900, minus 400, minus 300. Then you're just back here, right around your swing low again. But only got 128, 126, 152, right? The volume, isn't that much different, 1400, 900, 800. Yeah, here you had, 2000, but here's 1500, 800, 1100, 900, 900. And then boom, strong aggressive buying, 1689, max delta 1748. Next bar, 836. We close the final delta also at 836. Min delta minus 19. It's nothing, right? As the market is moving higher. Now, this was yesterday, just before the cash close, and this was very interesting. What was happening in the market, right? You got these new highs, right? This is what you like to see at new highs, right? Big, strong, positive delta, max delta, very, closing near the final delta closing near your max delta, very small min deltas. In these cases, they're zero. But for this market to keep going higher, you want to see the follow through. And then in the next bar, it starts out max delta 180, min delta closes at 31, or min delta is at 316, minus 316. Final delta closes at 177. Do you think this market is going higher or not? You had the aggressive buying earlier, you had the nice positive delta earlier, but aggressive sellers took control of this bar. Strong min delta, final delta closed negative, decent negative, minus 177. Say you're still not convinced, wait for the next bar. Okay, this next bar right here, max delta of 1. It's nothing. There's no aggressive buyers. Min delta minus 822, final delta minus 445. Okay, so now, yeah, that aggressive selling. This honestly in the S&Ps you get a lot. This algo pop around 250. 10 minutes for the cash close, but then it dries up. You don't have that aggressive buying anymore, and instead you're seeing the aggressive selling. And you take this quick move from 24, 25 all the way down into the teens. Now this is gold, right? Because a lot of people look at other markets besides E-minis, but take a look at this bar, right? You see the market going down, down, down. You see this big red bar. Oh my gosh, we're going lower. We're going to trade below 1690. But what happens, right? If you see this bar, it's got a delta of just minus 13, right? You're expecting a big down red candle to have a big strong negative delta. And at one point, it had a strong min delta, minus 203. So at one point in this bar, the delta number was showing up as minus 203, but buying came back in. It only closed at minus 13. So very early in that bar, min delta minus 203, looking very bearish, but it ate all it back. All the aggressive buying came in, turned it from minus 203 to just minus 13. That's bullish, right? Because halfway through this bar, when it was very bearish, aggressive buyers came in and bought the market, moved it back higher. Then the next bar, mostly max delta, min delta minus 2, max delta 94, final delta closed at 91. In the next bar, to a certain extent, min delta minus 5, you can see 37 max delta, final delta 32. And then obviously in the next bar, but by this point, you should have already been along off of, somewhere in this bar or early in this bar. This one's just all buying. Right? You see 0 min delta, max delta 136, final delta 133. So remember, for a market to move in the direction you expect it to, there needs to be follow through order flow in the direction you expect the market to move, right? Because without that follow through order flow, what reason is there for the market to move, right? Your super duper indicator? No, markets move on the actual buying and selling taking place in the market, right? That's why it's important to understand how to read the market internals, what's happening in the market. So, I'm going to take you through a few examples here on how to use these market internals to nail trades, and if you're, I love that darts, the Dart World Championship. I never really understood it. When I first saw it on TV years ago, I thought, oh gosh, this is kind of lame. But it's actually kind of exciting. And trading should be exciting for you, right? And being able to use your skill as a trader is the same as being a professional athlete and being able to score or throw the darts and get 180 and or put the ball in the back of the net. And that's what trading is all about, putting the ball in the back of the net. So this was Monday on the S&Ps, the E-minis. And, we were making these new highs, from 55 all the way up to 59. And so there were some shorting opportunities, and I labeled them here A, B, C, D, and potentially E. So in this case, you want to be watching what's happening in the deltas, right? The max delta, the min delta, the cumulative delta. So I'm going to go through it easy here. So I'm going to talk about the cumulative delta. So yeah, point A, cumulative delta was 10,636. Point B is 9,875. Point C, 10,536. Okay, at point A, you got a nice strong positive cumulative delta. Point B, delta's a little bit weaker. Okay, it's only 900. Okay, point C, it's back up to 10,500. Okay, that's point C. Point D, it's 10,480. And by point E, I didn't label it there, that's the red arrow. It's back below 10,000. So think about it. What's going on, right? This market is going higher. Okay, 10 point A, 10,636 cumulative delta. Point B, a new higher high, but less delta. Okay, it's a sign the market is getting weaker. But again, if you shorted that, right, you got to be watching what's happening in the order flow, right? Go back here. So 9875. Okay, say you get short here. Okay, you get short. Does the market sell off? No, it just goes sideways. Okay, when the market's going sideways, that's not a good sign when you're in a trade. For me, I like to expect the market to move within two ticks, or sorry, within 2 bars after getting taking a trade, um, and as many as 5 bars. So between 2 to 5 is my target, right? If the market is not moving down, if I'm short and the market's not moving down here, so say I'm short immediately here, right? Right at the low of this bar here, right after this bar closes at 54 and a quarter. 1, 2, it's back up to 55 and a half. 3, 4, 5. This is my sign to get out. But more importantly, I got to be watching what's happening, in the delta. By the time I get back here, delta's grown back up to 10,000. Okay, yeah, I'm fine. Take my loss. Okay, I'm going to wait for the next trade. So market goes back up, a new high, a nice positive delta again. It's not high, it's 10,536 at point C. It's higher than B, but it's 100 contracts less than point A, but I'm not going to split hairs. It's relatively the same. D, again, still about the same, but again, I just rallied 4 points from 55 up to 59. Delta is still about the same. So what's that telling you, right? It's telling you that there's, even though there's aggressive buying, there's also aggressive selling, right? You should have a big positive jump in the cumulative delta, by between point A to point D. A should 10,636. Point D, yeah, you want it to be at least 11,000. I'm not going to say hard and fast it should be 500 contracts more, but it should be more, not about the same. Then as you start going sideways in here, it loses that delta, cumulative delta 10,480. You get into point E in here, it's only 9,900. So where's the strength in the market, right? It's not there. So if you're looking for this market to break out, it's probably not going to happen. And instead, the trade is probably going to be to the short side rather than to the long side. And what happens? The market sold off. So anytime you're up at new highs, right, you got to watch the cumulative delta. Is there strength or weakness showing? Right, so you can see here, right, 19,000, the first arrow, cumulative delta 19,400, second arrow 19,500, third arrow 20,400. So yeah, cumulative delta is expanding more positive. That's what you want to see on a market that's going to be trending higher, right? Not cumulative delta just sort of hanging around the same level and then losing some of that delta as you're at the high of the day. All right, you want to be seeing, for a market to keep going up, you're going to be expecting cumulative delta to keep rising, right? Now this is on Tuesday in the S&Ps. This was right after the cash open, and this was very interesting. Cash opened on Tuesday, sold off down to this 51 and 3/4 area, bounced back up, and it looked like it was starting to sell off, right? You see that negative delta here in this red bar, minus 861, minus 1300, minus 982, three big strong red bars down. Max delta 28, only 0.28. Min delta minus 966, minus 1500, minus 1000, and we're closing our final deltas right around those numbers. And then this green bar opens up, minus 840 on the min delta. So this delta number is showing minus 840, okay, right here. But then what happens in this bar? It reversed. It went from minus 840 to positive 412 max delta. Min delta minus 840, max delta 412. We closed at 355. So it is actually a swing of minus 840 to positive 400. So that's, a swing of 1,200 contracts from very strong min delta to strong max delta. So that's telling me this market's not going lower, even though these three bars very bearish, right? That's your sign to get long. And then the market, boom, immediately moved up from 55 above 60. This is bonds. This is a 5-minute chart. This is yesterday. Excuse me. So what do you see? Again, sometimes, trading the market's going to be a little bit detective, right? Okay, the market's popping up, going a little bit higher here. You can see mostly max delta in these three bars here, 42, 30, 556. So final delta is positives. You can see max delta 117 versus 0, 71 versus minus 5, 586 versus 0. Okay, yeah, maybe this market go higher, but then it sort of drops off a little bit and goes sideways. Okay, but when we're going sideways, what are you seeing? Yeah, you see negative deltas, minus 221, minus 29, minus 175, minus 17, minus 316. But look at the max delta. Very little aggressive buying. 0, 16, 0, 0, 0. So when I say very little aggressive buying in the max delta, what I mean is aggressive buyers weren't in control in 4 out of 5 of these bars. Even though there's some volume traded on the offer, it's not enough to turn the delta positive, except this one case that's got small delta of minus 29. There was 16, but everything else 0, 0, 0. Min delta minus 280, minus 62, minus 238, minus 62, minus 335, right? And then the next two bars, this next bar, 0 min delta, all max delta, and then min delta, max delta, positive delta. But looking at these bars in here, which direction do you think the market's going to go? Going to go up or going to go down? Right? It's more inclined. It's telling me it went sideways in here, and there was supply coming into the market. Okay, if you're ever traded institutionally and you got a lot of supply, you're going to know that you don't want to put your foot on the gas pedal, right? You sell some, you let the market pause. This is that pause, then you sell some more, right? So you can see how the market dropped from, the 26 area down into new lows at 06, at 05. So order flow analysis provides the trader advanced information that they need to gain an edge over other traders, right? Order flow allows you to see and understand what is happening in the markets that other traders just don't see, right? So hopefully you can see how powerful order flow trading is, right? Don't overcomplicate trading. Trade what's happening right in front of you. So if you found this helpful, I hope you did, you will really like my Order Flows Trader 2.0 software package, which makes order flow analysis very easy. So, who wants to learn order flow analysis and add it to their trading? So there's two ways. One, you could do it on your own. You could spend a year looking at a chart, trying to figure out order flow. You waste a year losing more money trading, basically. And when I ask you a year later from now, when you attend one of my presentations or watch a video, I'm going to ask you how your trading is going. You're going to look like Rambo. Or number two, get the education and software from a trader who has successfully traded order flow at the highest level for literally decades. Skip the massive trading losses, skip the wasted time. And the way I like to describe it is, imagine you're at Disneyland with your family and Mickey Mouse comes up to you and says, hey, come with me, go to the front of the line. That's what I'm offering you today. The Order Flows Trader 2.0 for NinjaTrader 8. We're probably going to have an Order Flows 3.0 later this summer. It's several months away, so don't email me asking for the upgrade now, because it's probably not till August or September, and it's going to be a free upgrade. and it works on NinjaTrader 8. It doesn't work on Thinkorswim, doesn't work on TradeStation. It's on a NinjaTrader 8, and it'll work on the free version. Is the volume footprint chart that you saw generated with these charts in here in this presentation. There's 7 pre-programmed order flow indicators. I didn't even talk about those today. I just talked about the simple deltas. You're gonna get my chart template, and normally this is $899. But having order flow software is one thing. The next thing is knowing how to use it. I just don't give you the software, send you on your way. I provide you a lot of education on how to trade order flow. And for example, one of the things that I offer when you get my software is I do a weekly live group training session for users. It's on Tuesday nights now. It used to be Monday, but it's Tuesday now. And if you can't attend, you can watch the recordings. And again, there's some people out there that, you spend $2,000 on your software, then you want to join the group, then you got to pay another $200 a month. What for? First of all, I don't charge that amount. And, for a weekly group training, where you could ask questions, that's free. It should be free. But I'm also going to give you the order flows trading course, which I normally sell for $297 on my website. I'm going to give you access to my order flows inner circle video series, which, there's 56 videos on advanced order flow training, tips, tricks, and analysis. So if you put all that together, it's, close to $1,700. The software, the training, the live training, the inner circle. And as a special bonus, because of Investors Expo, I'm gonna give you access to my favorite course that I created, the Order Flows Playbook. So you add that up, it's close to $2,000. And other traders have got my software and they see that how helpful it is, and they posted, Mike, this software is remarkably helpful. I can clearly see now what's happening in the market on a very specific time and who's getting weaker as well. Other people say, um, you know, posting comments on my videos. You give really fresh, insane air in the field, very impressive, very rare. So time to think about success, right? Is the plan, then you're going to reach success. Being a successful trader is just not going to fall in your lap. So you can get all of this stuff for just a one-time payment of $675. So go to orderflows.com. The link is in the chat there. There's no monthly payments, no other payments in the future. So, you're good to go, right? And that's how it should be in trading, right? You want to get started as fast as you can. So go to orderflows.com/off2. It's going to take you to this page. Just scroll down, takes you to this button, buy now. I want this, right? It's processed by PayPal. I don't deal with your credit card. I don't want it. So just go through that. Then, within an hour or two, or depending on how long it takes to process your payment to get processed, you're done. I'll send you all the information. Now, if you want my book, go to orderflows.com/book.html. You got to enter your name and email address, and it'll take you to the download page after. So, if act now. It's a cliche, act now, but really, if you want to become a successful trader, you got to take action, right? You got to take that step forward and get from point A to point B as quickly as possible.
All right, welcome everyone. Thank you for joining me. Thank you for having me, Anna. And today we're going to talk about algorithmic trading, otherwise known as algo trading. And we're going to see if there's any benefit to getting involved with algo trading and how this might work in either bull or bear markets. So with that said, let's go ahead and remember one thing. We are speculating. We're speculating as prices move, and we're trying to make money, we're trying to profit, but we have to accept risk. So there's always risk when we speculate. So do take a moment to read the risk disclosure. It is important. Keep in mind that all funds committed should be risk capital, and past performance is no guarantee of future results. So our goal today, we're going to look at technology that a lot of experts are using, how to transform your trading, a very user-friendly autopilot platform. You can diversify among global markets, and we'll look at volatility in terms of how algos can either go long or short. They don't have an opinion. So stick around, we're going to focus, we're going to use our time wisely, and we're going to have a live demo. Then we're going to have a special offer for you worth over $24,000. We're going to get that at a, well, ridiculous discount or even free. So stick around for that. So here we go. let's look at what's happening in the markets this week, talk a little bit about who we are, look at 4 trading secrets, and looking here at algo traders, and we'll have that live demonstration, and then we'll show you how to get started. So just a quick review of what's happening in the market this week. Big disconnect between fundamentals and stock prices. I'm sure you're aware of that. A lot of people warning about that, but meanwhile, the stock market just does not care about all the negative news. In fact, the worse it gets, the better the stock market seems to do. Here's unemployment. You have now, what, over 42 million during an 11-week period. Pretty dramatic numbers. Wells Fargo, they're holding back on lending, worried about defaults. I think that you're going to see more of that in the weeks and months to come, unfortunately. Here's California, the big state of California, second largest here in the union. They're looking at allowing people just to walk away from their commercial leases. So it's pretty dark out there. And how about this? Here's Mohammed El Arian. If you haven't followed him, he's good to follow. But really, the markets are moving up based on one thing only, and that is stimulus from the Fed as well as from Congress. So that's what's keeping the markets up, sort of the Fed put under the market. Fed creating the largest asset bubble ever. I think that's probably not even arguable or debatable. Valuations are screaming higher. Warren Buffett likes to look at this. Here's the stock market versus GDP, essentially Wilshire 5000 broad base index. It's the basically the highest value that it's ever been. So something to keep an eye on for sure. Stocks are moving in parabolic manner. They're just since that March low, as you know. And here's someone here suggesting the Federal Reserve has made a big mistake with their policy. And here's an interesting one. Look at corporate profits. This is that orange line here. Corporate profits, as we can expect, are absolutely plunging. But meanwhile, look at the value of the S&P 500, almost approaching where it was. In fact, the NASDAQ now is at all-time highs. So this spread here is just enormous now. There's a lot of disconnect going on. Congressional Budget Office says it's going to take a decade to recover GDP growth. Look at here. So you're looking out, and then you're still barely above positive growth 10 years out, according to the CBO. So I thought this was funny from Hedgeye. I am long delusions, wishful thinking, and FOMO. Anyway, and then here's another risk bubbling up, US-China tensions, so that geopolitical risk. But here, look at this. With all that going on, S&P 500 just keeps getting stronger and stronger. Look at the euro currency. And don't worry if you're not following these markets real closely. I'm going to show you why it doesn't even matter. Crude oil, gold, and here's one just for kicks, soybeans. You're thinking, what the heck? When's the last time you followed soybeans? Probably never, and that's okay. You don't have to. So really, markets are always correct. That's the whole point. It can be expensive trying to convince the markets that you are correct. That's from Ed Sequoia. He's a market wizard. Great book if you haven't read it. So we want to trade what the market offers us, trade the environment up or down, but we need a new approach. We want to use robots for that. 1,700, actually it's 1,800 algo systems on the platform, one-click activation and deactivation. You don't need to watch your screens, and everything's automated. A little bit about who we are. There we are on the trading floor years ago, not too long ago actually, maybe 10 years ago, but there's no one on the trading floor anymore. And, that's because of algos, and we're going to show you how to get involved. We've been doing this since 1997. That's a picture I took on the trading floor, I believe in New York on the NYMEX. I think that was Coffee, Sugar, Cocoa Exchange. We've traded millions and millions of futures and options contracts over the years. So we've been doing this a long time. We're regulated. We have offices here at California and Illinois. Here's a short little crude video I took. It's on the NYMEX floor. Anyway, a lot of fun, very effective. It looks like chaos, but it's not. So with that said, who am I? I am Erik Gebhard. I've been doing this about well, almost 30 years now. Since 1991, I'm my BS in Business Administration from the University of Southern California, and I'm a co-founder here of Altivest. I got started way back when during an investments course at USC. That's my textbook there. We're looking at futures markets and options markets against the backdrop of crude oil and gold prices surging when Saddam Hussein invaded Kuwait and blew up all the oil fields. That was a very dramatic time. And I was in the securities industry for a time, but eventually the futures and options markets really caught my interest, and that's where I ended up, and that's where I still am. So with that said, let's go ahead and let me do this here so we have more room on the screen. I'm going to shut off the webcam for now. We're looking at 4 trading secrets here. Don't try to figure this out by yourself. That's secret 1. There's too much to figure out, and allow people who've been doing it for years to help you out. So we've learned what works, what doesn't work, and we've traded, like I said, millions of contracts the last 20 years, spoken all over the country, doing webinars and live presentations as well. So Thomas Edison said we've not failed, just found 10,000 ways that don't work. That's the way we like to look at it. So here, experience matters. We're going to show you automated trading systems built with experience, decades of input and experience. Secret 2, if you're wanting to be like a day trader, remember it's not that easy, folks, and you've got other things to do. You probably don't want to sit behind this screen. What is that, 30 monitors there? But what I'm getting at is if you're doing it and you're successful day trading, more power to you. But here are the odds. This is a guy who trained 300 to 400 people over a 5-year period that came through their day trading school. He said you ended up with about a 3.5% to 4.5% success rate. So that's those are long odds. It can be done, but remember it's not easy. And why is it not easy? Because you have to be really perfect with so many different variables, picking the market, the direction, the strategy, your entry timing and price, and then of course you have to exit that risk and reward. Then turns out here that monkeys do a much better job than we do at picking stocks. Average monkey outperformed the index by an average of 1.7% per year. So there is your best money manager right there. And then how about this, our emotions? There's Maxwell Smart, a little bit perplexed. And that's because it's difficult because of us. We've become our own worst enemy. Our emotions get in our way. The fear, the hope, the greed, the anxiety, the boredom, all those things when we're managing money. We have bad wiring. We have a built-in bias to make poor investment decisions. This is a great phrase here. Your brain is killing your returns. That's from Real Investment Advice. This was interesting. I just noticed this. I thought I'd keep this in here. Frustrated sports punters or bettors turning to the U.S. stock market because there's no sports to bet on. So very interesting. Look at this. These big online brokerage firms, huge surge in activity and new account volume because basically people are bored or they want to gamble. And look at that with Robinhood, huge spike in stock positions from Robin. I think they even had an outage, another outage. They've had several in the last couple of months. So remember, our emotions become our enemy. Look at this, interesting. Here's a guy at E-Trade. He fired up his E-Trade account with several $1,000s. He began to buy stocks. He says, I'm not here for the long run. I just want to throw a few $1,000s at something to see if I can make a few hundred. So anyway, that's some gambling right there, that's for sure. So we have basically these 3 common biases from Motley Fool: confirmation bias, anchoring bias, and recency bias. And any one of those will end up putting you in the wrong spot. I thought this was funny. Go to your grave still thinking that you were correct and the market was wrong. So here's part 4, algos and why they're dominating, how they're dominating. Here's Bloomberg, robot analyst outwit humans on their investment picks. Thought this was a great cartoon. This guy's struggling, meanwhile the robot's already done. Algos and investors, so Wall Street, as you know, institutions, sovereign wealth funds, hedge funds, you name it, they're all using algos to automatically buy and sell. And basically they make up 80% of the volume now. They're dominating. They perpetuate fast market moves. They lead to the fastest selling in bear markets and probably rallies as well. And algorithmic trading creates more stock volatility, especially in this last month or two. it's getting harder and harder to be a human and make a good living beating and winning in the financial markets. It's according to Michael McDonald here. He's an energy trader. So revolutionary trading, starting here back in the the caveman era, moving up to the robot era. So that's what it used to look like, and now this is what it looks like. So this is our competition. No human emotion, automated entry and exit, built-in risk controls, sort of like the Terminator. Remember this from the movie. The Terminator's out there. It can't be bargained with, it can't be reasoned with. It doesn't feel pity or remorse or fear, and it will absolutely not stop ever until your account is dead. So I took liberties with the dialogue, but you get the picture. So can you use algos to compete? Absolutely. So let's see if we can use them to help us and not fight against them. We have automated systems trading. That's your solution. User-friendly for novice or advanced traders, either way. And let's take a look here. Want to make sure. And you can filter for risk and reward parameters. 5 minutes a day, automate those risk and profit controls, set to on and off and walk away. Up and down markets, it doesn't matter. Global markets, multiple sectors. So we're going to jump in here to a live demo. So just one moment here while I switch screens, and we're going to meet what we call the traders of AV systems. So go ahead and let me switch. All right, very good. Successfully switched. Now you're looking at the dashboard here. Here's the dashboard for AV systems. And we've got enough time here to run through this, and it's going to look a little bit complicated at first, but really it's very simple. So we'll just go through this step by step. Follow the 1, 2, 3, and 4. So really all you do is you would explore the systems on the platform. And once you choose one or more of the systems, you would subscribe to a system. And once you do that, then you have to activate or just flip the switch off or on, in this case on. And then once it's activated, you just monitor the performance. It's just that easy. So let's start here with number 1. How do you explore or choose systems? Well, first of all, you can see there's about 1,811 exactly on the platform at the moment. We're looking here on this first page of systems number 1 through 25. Now you can see basically each one of these lines is a particular system, and we're going to drill down and show you more about that. But first of all, let me look at this table here, this table and all these headlines here. You can customize that. So if you maybe don't want to see the profit factor, and maybe you don't care about this TM rating or the name of the developer, and maybe you'd rather have information on the worst percentage losing session here, and you can then just go ahead and click OK, and now this table will reflect all the choices that you've input. And of course you can go in ascending or descending order by clicking on any of the headings there. You can see that. That's one way to filter as well. Required capital, for example. So that's one way to customize the table. Let me just go back to the default setting. But now really, here's the most important thing is how would you choose a system? Well, use the filters. This is really the best thing, one of the best tools on the platform. So for example, there are some quick filters you could use. And let's say in this case, you want to look at all the systems that have been tracked for more than 1 year and they have profits since being tracked. So you click on that, now you've got that filter in place, and now you have 503 systems. And let's say there's the worst drawdown was less than 10,000 and it has a rating of 2 or better. And that's also one of your filters. So now you have 300 systems to look at. Okay, so, or I like this one a lot, the advanced filters. You can get very granular and very detailed, and you can look at performance, so risk and returns. So this is all historical performance on these systems. You could look at a description here and filter based on description, or just the actual track record in terms of when it started, live performance, so on and so forth. So let's say here you want to look at something where the required capital is, let's say, maybe $20,000 or less. Okay, so now you're down to 285. And now if you want to maybe say, let's just look at something like it's been live. It's been trading live since a particular date. I don't know, let's just say 2000 and let's just say last year, 2009, August 9 of 2000 last year. Okay, now you have 98 to choose from. So you can get very granular and you see how that works. And now you can see the table there and you could scroll page by page and look at the systems. But even so, you might be thinking, okay, well, where do I even begin? Because there's still a lot to choose from. Well, once again, you can drill down even further and get more and more granular and really narrow it down to something that is appropriate for you and your risk and reward tolerance. So for example, here's one where maybe you want to look at the Sharpe ratio, just a measure of risk adjusted return. Let's see if usually a Sharpe ratio of 1 to 2 would be really good. Let's see if this does anything for us here. Yeah, so now we're down even further. So you get the picture. Now I want to point out, let's look at what we'll do here before let me just clear all these. And what I want to do here now is, let's set this back to default. I want to show you, for example, let's just pick this one right here, silver metal trend. You click on this, you drill down, and let's pull up the graph here. So here's a graph of this one. In fact, this is probably not, let me pick a different one. Just a second here. Let's see here, just a second. Here we go. Let's do this one here. That other silver one had a capital requirement. I think that was way too high. So here we go. This is a copper system. You can see the name of the developer. The product here is copper. It's an intraday system. That means it's in and out by the same day. You would pay the developer $60 a month. It comes right out of your account. And this here is the graph of the performance. Let me show you up here. I'm sorry, up here. Total profit and loss, tracked profit and loss, live P&L. Here's your worst drawdown, $7,900, suggested capital and required capital. And I want to point out that all the performance data is based off of the suggested capital requirement, or suggestion, I should say. So if you were to use the required capital, you would increase your leverage quite a bit. So really all the numbers are based on the suggested capital. Now here's all the metrics here, and if you want to know what any of these mean, you just click on the little button there, the icon. But you can see here this table. This is kind of important. So this system has been back tested all the way down back till 2009, you can see here. And this highlighted section here where it's sort of tan, that's tracked on the platform. So it's been locked down. The algo's been on the AV system platform for that time period. So since looks like 2017, May of 2017. And then what happens is when people start trading it with live money, it turns green. So you can see these sections here, these different months where it has turned green. So that means there's actual live money. So let me point out something here. You can see this is this year, January, February, March, April, May, June. Take a look here. March seems to have done well in March. And meanwhile, remember what happened to the stock market. So that's why we like systems in a big way, because they are non-correlated to what's happening in the stock market, because you can be in any market and the system can be short or long. So you can see here in March 2, $60 came out of the account because that's what pays the developer. And then you can see on the 9th it had a winning trade, the 12th a winning trade, the 19th, and then the 23rd was a losing trade. So you see all full transparency. It's very granular. You get to see exactly what's happening on these systems. Now let me show you here, and we'll back up just a second, but let me show you on this other system called Samurai Copper, for example. I'm going to show you how to turn a system off and on, but you can see the performance here. This one's doing very well. Once again, look at March. It had a great performance there in March. I always like to look at how systems do when, say, the stock market is not doing well. So let's go back to that Samurai Copper, and we'll move it right along, and we'll show you some live trading here. So you can see, I want to point out the full transparency. Here's the trade log. You can see all the trading that's been occurring. And then if you want to just see the log for a particular session, you can. So if you like this particular system and the way it looks and the risk and reward, and you're comfortable with the largest, you can see the worst session lost $2,200, the best session won $3,700. You can see percentage of time in a position, so on and so forth. So what you do is you go here and you would buy the license and you would subscribe and you click accept. And now, once you've done that, you would need to activate. So you click activate, and we're not going to do it here, but you would just choose to immediately or enter at the next entry or at or better price. A lot of times I think it's best just to go with immediate activation. Then of course you read the disclaimer and then you click activate. Well, let's go ahead and click it. I don't know if I have a demo account running, but I don't know if there's enough funds in the demo account. Okay, it's already active, that's why. Well, here, let's take a look at it. So what would you do? How would you follow it? Let's look at number 4. You go to My Systems. Okay, yeah, there it is. There's the copper system. So here we go. You can see here that right now you have an E-mini S&P 500 system going, and it's losing $335 today. But since we turned on the system, it's making $3,200. And then here's this copper system, has no position at the moment, and it's up $925. And here's another silver position here, another silver system. It's losing about $60 today, $30. This is live. You can see the numbers changing, and you can see your accumulation here, accumulated with these 3 systems since I turned them on in the demo account, $6,000. Now here, if you want to deactivate a system, all you do is click Stop Strategy, and you can stop it immediately. Or you could just wait till this one is, this position is closed out, then you deactivate. It's just that easy. So you can activate a system and walk away and just let it work its magic. And that's what we like to do. We don't like to get too involved in trying to second guess the system and get in and out, every day. I think you can overdo it. In fact, we have some people that have just turned on systems and walked away. And this is interesting here too. Look at this performance in March. This one here just absolutely had a tremendous month of March as the volatility picked up in the stock market. So you can see day by day all the trading activity on this one here, and you can see it's a swing system, meaning it may try to hold a position for more than a day. But once again, everything's transparent. There's nothing hidden. All the trading is fully visible to you. And then, of course, you can see all of the, let me show you here, the session logs, and it gives you, oh yeah, I already showed you that, I'm sorry. But it shows you here on the trade log, the type of order being used, the quantity, and so on and so forth. So there you have it. That's how that works. And let me show you here one other thing, top 10. So if you want to know at a glance what the best systems are on any given day or month or year, this is how you do it. You just go to top 10. You can see these are all trading live at the moment. So you can see this one here, it's a gold system, and currently it's long from 1727. Here's another system here from Sirius Trading on the euro currency. It's currently long from 112.38. Here's another gold. Here's a euro currency. Here's wheat, soybeans, NASDAQ. Doesn't really matter, but you can see how any of these are doing at any time. You can look at historical performance and look at those top 10. And look at this one here. This is now this is a DAX, D-A-X. That's a German stock market index. It's a very, very liquid market. A lot of these systems work well on the DAX stock market index. And once again, you don't need to know anything about the DAX stock market index. The algo does all the work for you. Here's, let's take a look here real quickly and see how this is doing. This is interesting. Required capital is pretty low. Suggested capital is actually quite low at 15,000. It's been trading live here since earlier this year. Seems to be doing well. And look again here, you have that big drawdown in March in the stock market, and this particular system seems to have done pretty well. Looks like there's a delay on that window. There it goes. So that's why we like these systems. They're non-correlated. They have absolute return characteristics. And I think that's a good overview of the actual platform. So let me jump out and show you what's next. Just one moment. Okay. Hopefully you don't feel like this kid drinking from the fire hose. So now here's what you're thinking, because this is what people say. That's great, but I've never traded futures. Well, remember, it's not complicated because the algos do all the work for you. You don't need to know about hogs or the Dow or the DAX or the crude oil or copper. You don't need to study the charts or the fundamentals. The algos do all the work for you. Remember, metals, energies, stocks, currencies, you name it. And remember, futures trading is the place to be. Record volumes, 43% jump in volume, 11.4 billion contracts. This is where you want to be. You can filter for risk, profit, capital, whatever you need. You can see how easy it is to filter. And it's fun and simple. So you're thinking, how do I get started? Here we go. We have an elite membership or the pro membership. Let me show you what's going on here with those two. Elite membership is really, I think, the best way to automate your systems trading. Here's what you get. You get everything you just saw on the AV Systems platform, over 1,800 algos, 20 years of R&D, thousands of those system bots, like we said, US global markets, multiple sectors. You just flip the switch off and on. Everything's transparent. Automation, risk and profit management, day trading or swing trades. You can review your live system performance and you can sort and filter for any parameter that suits you. Global stock market indices, currencies, financials, bonds, metals, energies, you name it, grains. So it would cost to hire, how about just building one algo system? Ask us how we know. $10,800, I think that's actually undervalued. But you get a coach. So with your elite membership, one-on-one coaching, someone who's licensed, has been doing this for years, they can help you pick strategies, help you build allocations to strategies, a yearly value of at least $7,500, work with you on what we call our A list of our top systems that work well together with the capital that you have. So we have the AV Systems platform, your trading coach, and the A-list, a value of over $21,000. You could think of all the money you could save. You don't need all those newsletter subscriptions and so on and so forth, or data fees and whatnot. And I talk to people all the time, and they're paying a lot of money for that stuff. And then you can save a lot of time. I think that's sort of priceless. So I think it's the one tool that could work for you, save you the time, save you money, save you some stress and aggravation. Absolutely, this kid says you betcha. So we like clients that stick around with us for a long time. We have a lot of clients been with us for a long, long time. So if you're long-term serious about success, the AV Systems Elite membership is really the way to go. You have a value of over $21,000. And in fact, there's even a little bit more because we have proprietary research. Remember, we are a trading firm. We've been doing this for a long time. So this might even help you with your traditional assets in terms of the analysis that we do day by day with our trade scope and our daily commentary. Yearly value on that proprietary research, almost $3,000. So once again, you have the elite membership package, a value of over $24,000. So even at half price, it would be a great deal. I think you'd agree. So we can do better than that. And I know people, in fact, I spoke with all my career, another guy just showed up yesterday on my radar screen, talked to him. He paid $25,000 for a system. And it's something, a system I've heard of over the years. And anyway, people spend a fortune for trading systems. So I think we can do much, much better than that, over deliver on value. It is a live presentation. So here's what we have. Our AV Systems Elite membership price, $997, but we'll even drop that down 50% off for that AV Systems Elite membership, $497. So there is the link, cf.altivest.com/AVS Elite. And there's our phone number, 949-346-1373. Yes, we are real people. We've been doing this a long time. And that does expire Sunday night. So remember that special discount gets you half off, expires Sunday night, and there's a 30-day guarantee. So really, you don't have anything to risk in terms of your membership fee. If you sign up with us and you start researching the platform, or maybe something changes in your life and you decide you can't do it at the, let us know within 30 days and we'll refund that membership fee. And remember, it is a one-on-one type of service. This is not just something where we send you away and never ever, you never hear from us again. So we've been here doing this many years, and one payment, it's just a one-time fee. I want to make that clear. People always think it's monthly or quarterly or yearly. Nope. And here's something I bet you didn't know. Tax efficiency. If you're trading stock options, it's not tax efficient, folks. Here you go. You make 20% on 100 grand, you're going to pay 7,400 in tax, a rate of return of 12.6%. But if you're trading futures, which is what we trade, you'd pay only $5,360 in tax, and it's a 14.64% return. Tax savings of over $2,000 just because you're trading futures. It's tax efficient, and there's no itemizing. So there's no itemizing, and that means you just get your P&L for the year and you plug it into your taxes, and that's all you do. So here's what we get. We always get this question: can I trade with an IRA account? Yes, you may trade with your IRA account, and yes, we do take accounts. People transfer accounts to us from brokerage firms all the time, and then of course individual, joint, corporate, LLC, whatever, you name it. We can do all those types of accounts. People say, how much money should I trade with? Well, that's up to you and your risk tolerance, how much risk capital you have. But we suggest a minimum of 25 to 50,000 for the Elite AVS Systems Elite membership. So there's the link one more time. Now here, I want to show you something here before we move along. Remember, AV Systems, it's easy, there's no screen watching, and has decades of system design and development behind it. So here's that Elite membership. Now here's another way to get it. Here's one way to get it for free. 50,000 or more, and we'll rebate that elite membership fee. So open your account with 50,000 and we can rebate that for you. And here's something else we have. We call it the Pro membership for self-directed traders. So maybe you're thinking, I love everything about the AV Systems platform, and who wouldn't? But you think, well, I really don't need to talk to anyone. I'm just going to spend time and figure it out myself. And that's fine, because you can. It's not that difficult. But sometimes people like to have a sounding board and get, the opinion of others. That's why we offer the elite with that coaching, that one-on-one service. But if you don't think you need that, that's okay. You can go to cf.altivest.com/AVS free, and that's called our Pro membership. So really, you have the platform available to you. You just don't have that one-on-one coaching available to you. That's the only difference. But everything else from the technology perspective is the same. And why alternatives? Just to kind of summarize, well, we like the alternative space. Obviously, it's our business, but it may improve diversification and lower portfolio risk because they have a low correlation to traditional investments. Diversified investment portfolio. If you have stocks, bonds, and alternatives, it can help smooth the impact of market volatility and may generate higher returns relative to risk over time. Potential to improve the risk and return profile of a portfolio, may help grow that investor's total return. This is from a few months back, but I think it makes a lot of sense, and it will for many years. Mean reversion. Stock markets 10-year returns exhibit a strong tendency to regress to the mean. So that means really great decades are followed by mediocre or worse decades. So as you know, the last 10 years were tremendous, and the next 10 years, maybe not so much, just based off the mean reversion of history. This is what that tells us. So brace yourself for mediocre stock market returns in the next decade. Of course, since March, the returns have been tremendous, but that's a bit of an aberration. I think we'd all agree. Here's from AQR. He said future returns will be soberingly low in a traditional U.S. portfolio of 60-40 stocks bonds. He's looking at 2.4% in the next 5 to 10 years. That's Cliff Asness with AQR. So here's your portfolio, or is this your portfolio, or we like number 3, of course. So remember, non-correlation, that's what it's all about. Having access to and exposure to alternatives, such as the automated systems that we talked about. And you saw the difference there in how these systems can perform when, say, the stock market is not performing well. So there you have it, folks. And I'll go through the questions here. I'll leave that up, those 2 links. Okay, let's see here. Yeah, people ask about the deposit. Well, it just depends on the amount of risk capital you have, but we certainly you can see how the required capital amounts can differ from one system to another. So it's really a matter of which system and how many systems you want to trade at once. But if you have 50,000 or more, we'll rebate your membership fee. And let's see here. Someone's asking, yeah, they do. We have treasuries, absolutely. There are bond systems, absolutely are. Someone's asking about the brokerage. Yes, well, we are the brokerage firm. So you simply open your account with us here at AltiVest, and then you would be trading on the AV Systems platform. And yes, it's only for futures contracts, does not work with options or stocks, only futures. That's the place to be. And let's see here. And we are not a securities brokerage firm. So there's no margin interest or anything like that. You just open your account with cash, and then from there you trade the AV Systems platform. And unfortunately, we cannot work with Canadian accounts. It has nothing to do with us. It's just regulations, thanks to our 2 wonderful countries. And then if you want to look at historical returns on any particular system, it's available right on the platform. You just click on the name of the system, and you can see all of the return data for that particular system. Yeah, and there is a monthly cost for system. So the each developer is different, but it might be anywhere from, let's say, $10 to $100 per month, and that comes right out of your account. I'd say on average, we maybe $50, $60, $70 seems to be. And also the returns, I want to point out, they're all net. All the returns are net of trading cost, meaning the developer fees that you would pay each month, like that $50 a month that comes out of your account, and then all the commissions for the trading. So all of the data on the platform, when it mentions a 5% return or something for the month, that is net of all trading cost. Okay, and let's see here. Yes, we also do trade options, but not with this particular platform, but certainly give us a call and we can tell you about our option trading platform. We use an algorithm to pre-select option trades and manage the trades for us. Absolutely. Okay, and let's see here. So let's see, someone mentioned that their link wasn't working for them. Let me double check that for you, but I'm almost positive it is working correctly, but you never know. Let me double check that. cf.altivest.com/AVS Elite. Let's go ahead and double check that. And then of course the free one there, cf.altivest.com/AVS free. Yep, so anyway, that's gonna do it for you, for me, and thank you very much. Give us a call and we'd love to chat with you more about it, and have a great day. Thank you, bye-bye.
Hey, welcome guys, and welcome. Thank you so much for having me on the call, Anna, and all the people from Investor Expo. Today, hola, Trader. I remember that name, Trader. I'm thinking that's Norman, but I'm not sure. But help me out there, okay? But welcome, guys. Welcome to today's. I wanted to tell you about things that is happening in the market that unfortunately a lot of people think that this market is something that cannot be traded. Some people have given up hope. Everything is out the window. Nothing works. My goal here today is to show you that it doesn't have to be that way, and that there are certain things that work. It's just knowing what works to help you navigate through this market correctly. So without further ado, let me go ahead and start by doing this. This is our disclaimer. Again, just to make sure that we understand everything here. It's not a recommendation to buy, sell, or anything. Trading does involve risk, so please keep in mind that we are not licensed financial advisors. A little bit about myself. I've been in the finance and accounting industry for over 17 years. I studied accounting in college. I've been in trade and technical analysis in particular for over 8 years now. And what I did was, for those of you guys who were back when the financial crisis happened, I was one of those guys that got caught in that. I lost everything. And I just remember saying to myself, I vowed to myself, I don't want the next financial crisis or the next bear market or the next market crash to catch me off guard. I wanted to know everything there is to it so that way I could be prepared for it before it happens again. And so I am pleased to say that this time around, we were well aware of the crash that literally took place recently, and I'll show you some proof of that, and then really capitalized on that. And that's exactly everything that I had worked for after the financial crisis in 2008 came to fruition in this pandemic that we had. So that's kind of like what I did. So in the process of me wanting to understand the stock market, I wanted to specialize in identifying companies that are good, making sure that we get in at low prices, make sure that we minimize our risk as much as possible, and get into some stocks that can do really well. And that is what I do. And we do that strictly by looking at technical analysis. So we focus all our research. We did a lot of studies on so many different things, but predominantly we focus on price movements. We look at patterns and all that kind of stuff. And today I'm going to show you some of that stuff today. So I usually ask this question, is the stock market random? And I ask this question because a lot of people think that the stock market is random. Now, the name of our company is called Right Side Trading, and part of the reason why is because when I first started learning the stock market, one of my biggest skepticism was that, look, anybody can tell you what you should have done, could have done, would have done in hindsight. So they can come over here and say, oh, that's the bottom right there. You should have bought down here. You know, any one of these bottoms right here, you could have bought those. You could have, you know, this would be a good place to be buying. But the question is, when we over here right now, and because everything here is the left side of the chart, that's all in hindsight. The reason why we call it right side trade is because we have to then look at what is happening on the furthest right of the chart, which is right here, and determine based on information, data from the charts, what we see the charts communicating, whether it's communicating that it's ready to go up, whether it's saying it's ready to go down, or maybe it's saying nothing at all. But being able to see what those three different um, um, uh, outcomes could be is very, very important. And so we focus on identifying what could happen going forward, and that's what we do. So for that reason, I have a saying that goes like this: people get excited about stocks that have made huge moves, but the true credit, in our opinion, goes to those who can train their eyes or have trained their eyes to see the setup. And so today I'm going to show you a setup that likely most people have not been paying attention to. So hopefully that becomes something new to you today. If you have been paying attention to it, that's great. Then, you know, hopefully you use this to help you with your trading. But if you haven't, today I think you'll see something very interesting. Okay. Right before I jump into all this, can you guys relate to this? How many people can relate to this? You know, I say this because I see there's a lot out there. There's a big disconnect with the stock market and the economy. I mean, let's face it, we've had a pandemic followed by you know, record unemployment rates. We've had the protests going on right when things were beginning to start opening back up. People looking at fundamentals, and it's like, man, nothing works. It's like, how do we even navigate this market? Nothing makes sense. Why is the stock market going up, going down? How many people can actually relate to that? How many people actually felt that? It's like, how can we tell what's going on? It's like fundamentals is out the window. I mean, we've seen people on TV, people on YouTube, everybody's like, we don't know what's going on. Why is this market going up? Why is this market going up? And there's so many people that just was like, I'm fed up. I mean, there's people that are sitting on the sideline saying, I don't even know what to do. I'm just going to sit down. Okay. So Andres, I'm glad you said that. You know, I'll show you some things here. So first and foremost, the first thing I want to mention is that yes, fundamental might not work, but the one thing that I found that worked throughout this whole period, which I've been trying to tell people for so long, is that technical analysis does work. In the midst of when nothing else worked out there, technical analysis worked. And so we have a report. Here's the right side report. We have a report that we call right side report. It comes out every single week. On January 24th, you can see this right here. This is the report right here. You can see January 24th, we usually write it over the weekend, and then we send it out to our subscribers. These highlighted section, if you pause the video later on, you watch this, you'll see exactly what I wrote in that report. Right here, I just kind of blew it up a little bit, pointing out some of the things that I said. But it's very interesting because on January 24th, if you guys understand, the market had not started really tanking at that time. And in that report, we started seeing things in the market based on technical analysis that was telling us, get ready for a market drop. And so on that report, I started off by just saying, look, I will be discussing major indices, which is telling us that we should be prepared for a potential drop. We said potential because we honestly didn't know how bad it was going to get, but we knew something was wrong with the market. And the setup was there on January 24th. It says we'll also look at the VIX and how it's also beginning to shape up with spikes in volatility. Now, if you go back to the chart, you'll realize that most people were not even paying attention to that back then. But on January 24th, we were saying, wait a second, something is not right. The VIX is beginning to show signs. It's setting up for spikes in volatility. And we now know February, March were like one of the most volatile spikes in VIX since then. But we saw this January, towards the end of January, we started seeing that. Okay. And then over here in that same report, we had a concept that we call market in unison. And we said, we expect the uptrend that we had been seeing up until January 24th to come to an end. And then we said we need to be ready for either a slowdown at best. That's the best that we could see, was like maybe the market will slow down. But because of the warning signs we're seeing, the best we could probably expect is that the market will slow down. And the worst is that we're going to get a full-blown reversal. Okay. And then I even said it right here. So this is where we're not the type of people that say, oh, maybe you should buy, but it could also go down. You know, we think the market could go up, but it could also go down. Trying to hedge ourselves. It's like, no, when you see information and you know what it's saying, it's easy to pick a side. And so the writing is already on the wall. Those are bold statements. It is time to take profits, exit positions. The market is warning us to take heed. These are very strong, bold statements that we made on January 23rd. I mean, January 24th, saying that the market is ready to go down. If you have any profits, take your profits. If you're in any position, exit your positions. This is not the time to be going long in the market. Now, we're not the prime of bear type of people who are always preaching that the market is going to go, down for the last 10 years. No, we literally just said that on the 24th because of the things that we saw. Now, the rest is history. We had one of the worst market drops that we've seen in a very long time. That happened. Okay, so then what happened? After that, we're telling people, we said, look, when the market hits bottom, we'll see it as well. Because if you understand the right type of technical analysis to look at, you would know and see when the market is communicating certain things. And so during the whole time that the market was dropping and everybody was panicking, most people are asking, where's the bottom? Where's the bottom? So look, the day that it shows up, we'll see it. And so if you see on this report now, this is now dated March 23rd, March 27th. So the market hit bottom on the 23rd. We actually saw that, but we didn't write the report until that weekend, which was March 27th. And so in that report, we said, the question is, have we found the bottom or is this just a relief rally? And the reason why I said that is because I knew that a lot of people would say, oh, wow, it's just a bear market rally. It's just a relief rally. It's going to keep on going down. And then here's the answer that we put it again. You can read it all in here. This was all the report. It says, acting to the bearish signals that warned us about a bearish drop, this time the market is communicating that it is time to cover any short position, exit all your shorts, and get ready for a rally. That was what we said on the report by the end of that week. How did we see these things? This is not just, again, these are bold statements where a lot of people's like, well, maybe we might get a rally. It's going to be a relief rally. Then it's going to form a double bottom. It's going to come back down. No, we said, no. Get out of all your shorts. Get out of all your shorts because the market was very clear that it was ready to go down. So I'll show you just one, because I don't have time to show you, everything. I mean, technical analysis is not something you're going to learn over a 45-minute, session. But I'm gonna just show you one thing that we saw that showed us that, wait a second, we're seeing the bottom, okay? And hopefully from here on out, you guys will be able to use this to help yourself with trading. So let's navigate the markets. The candlestick that I'm gonna show you guys is this candlestick out here. Has anybody ever seen this candlestick out here? Now, I'll be honest, when we discovered this, we didn't know what the name was, okay? We had just, in my studies of yeah, you can type in your answer, guys. Yeah, absolutely. Anybody knows what this is. If you don't know what it is, just type in an N. I would appreciate it. Just lets me know that everybody can still hear me, see me. I'm interacting with everybody. Okay, here is a candlestick that we call a bottoms up. Now, I don't know what a technical name for it is. It's not a harami, okay? It's not a harami, actually. Thank you so much for that, Mills. It's not a harami. This one is, see, a harami would have been, this top right here would be white wares, but this bottom would have been a little higher, okay? So this looks like a Pearson, very good, whoever member is, okay? But sometimes it's not always a Pearson because a Pearson has to always go above. So sometimes we've seen this where, let's say this is the red candle here, and if this is the green candle, it could even be something like this, okay? And at that point, it won't be a Pearson. But, that's a very good point that you mentioned, Pearson. The way this is actually drawn right now, yes, this is a Pearson candle as it's drawn right now, but that's not the one that we trying to focus on. So let me just give you some parameters because the idea here is that we don't care about the wicks. So with a Pearson candle, there's usually a wick, okay? So and I don't want to go too far into that, but anyways, just believe me that it's not a Pearson candle, okay? Because I can show you the big difference between the Pearson candle and this. This is not a Pearson candle. The biggest thing we want to focus on is one, we ignore the wicks, okay? So ignore any wicks on this candle. So we don't even bother with the wick. So even if it had a wick at the top, wick at the bottom, wick at the top, wick at the bottom, we would have completely ignored the wick, okay? And the piercing candle, you have to include the wicks. So first we ignore the wick. But the most important thing that we are paying attention to is the fact that the body of this green candle, the bottom of this green body is below the bottom of the red. That's the most important thing, okay? And then we want to make sure that the top of this green candle is also below the top of the red candle, right? That's the biggest thing. You ignore all the wicks, and we just want to make sure that the bottom of this is below the bottom of the red, and the top of this green is below the top of red. Give me a Y if you understand that, so we can move on. Just make sure that we all on the same page, because I'm about to show you guys. We're gonna go faster from here. If you get this, I mean, even if you need, thank you guys, thank you. Okay. Even if you have to like take a screenshot of this, by all means do so. But again, I discovered this when I was doing my research on market bottoms, because you hear a lot of people talk about a bubble, a bubble, a bubble, a bubble, a bubble. But how many times do you hear them talk about here's the bottom? And so as much as I was afraid of another market crash, as I started doing my study, because that was my biggest motivation when I first started researching the stock market, was I wanted to know when the next bubble was going to pop, because I didn't want to be the kind of person, hanging around believing that, oh yeah, it's always going to be a bubble, and it's been a bubble for 10 years, and one day it's going to pop. One day it's going to pop. I want to know, when is the popping happening? Okay, I don't like this mentality of like, okay, yeah, it can't go up forever. Eventually it's going to pop. I get that. Eventually it's going to pop, but when? That's my thing. I want to know, is it today? Is it next week? Is it last week? When did it happen? And I don't want it to be in hindsight, where after the carnage has already taken place, then people say, oh, that was the pop. Okay. And so I studied that a lot, but then in my studies, I started realizing, I said, wait a second, well, how do we know when the crash is over? Like, how do we see that? And so that's what prompted me to go back and start doing some studies on, well, where are the bottoms of these crashing, and what were some of the patterns that we saw? Because again, I don't believe the stock market is random. Random means that there's a lack of patterns. And I saw so many patterns, and one of the patterns that I saw was this right here. And so at the time I was like, wow, so we end up calling it bottoms up, long story short. So let me show you what this looks like on the chart, and why we were so adamant that, look, this market is not, I mean, to me, and I've been saying this, I've been preaching this for quite some time now, since March, really. By April 4th, we were fully invested long in the market, like completely invested. I was telling my subscribers, don't have a single penny that is not invested long in the market, because you are going to miss out, right? And if you look at this is that same pattern right here, ladies and gentlemen. So for the person, I can't remember who it was, for the person that said piercing candle, okay? If you looked at this would not be a piercing candle, because the piercing candle would have to be all the way below this wick right here, okay? So a piercing candle would have to start below this wick. So this is why it's not necessarily a piercing candle. In this case, all we want to see is the body. Again, we ignore the wicks, look at the body. It started below this body and it ended above this. So by the time this happened at the end of April, I was telling people, I said, guys, if you're not in this market, don't say you got left behind, pure and simple. Now, why is this important? Well, the market has now told us that it has a bottoms up. Well, guess what? Do you guys remember when we had the big drop, the trade war drop back in 2018, October, November, December? I know a lot of people who said they made so much money from January, and then October to December, they literally lost it all. Some people got so scared they didn't even want to get back in the stock market anymore, right? Well, what they were not aware of was this right here. The same exact pattern, that even though December 24 was the exact bottom, by December 26, the market started going up. At least by the end of January, they would have known, wait a second, this market is going back to potentially all-time highs. But they literally missed out on all this rally because they were so afraid of what happened here. They got spooked, they got injured, they lost a lot of money. And then what ended up happening is, by the time they decided to get back in, somewhere up here is when they started getting back in. It's, oh man. And it was so crazy because now the media is like, oh yeah, the bottom of, December 24 was the bottom. Everybody wants to talk about the bottom after it happened. When it's happening, they say, is this the bottom? Is this not the bottom? Is what they all say, right? And then later on, oh yeah, this was the bottom. And then unfortunately, people got in there, market came tanking down again. And right now, I'm seeing people literally saying, look, I'm sitting on the sidelines. I don't know. This doesn't make any sense. Look at everything around you. They said Warren Buffett sold his airline stock. So that must mean that he knows something that we don't know. He's not invested. Okay. And then they said they tell you to look at the protest that's going on, look at the pandemic, look at the unemployment rate. Everything is happening. And then the market keeps on going higher and higher. People's like, how can this be? Fundamentals doesn't make any sense. Well, that's because technical analysis was already telling you, hey, wait a second, we're ready to go back up. This is a pattern that shows up at the bottom before it starts rallying back up. Interesting. This was the financial crisis where I got in trouble. And like Mills says, exactly, Mills, you can't fight the Fed. That was one of the things we wrote in the report. Because one of the things we did was we were monitoring what the Fed did, and we even went back. We did a whole study of like what happened the first time in 2008 when they did the financial crisis, and how the technical analysis was showing what was showing up on technical analysis each way along the progress of all these Fed announcements that they were doing to kind of do this whole quantitative easing back then. And so we did that too. We wrote that all in our reports and everything. And we told people, so look, you cannot fight the Feds. I said, the Feds have said they are going to buy up everything, right? They're going to buy up everything. They're going to put money in the market. And here's the difference. The difference between now and 2008 was, in 2008, at least America was the only one doing it, right? Everybody was sitting on the sideline watching to see whether America was going to like win or not, or whether they're going to succeed or not. Now you have China saying it, you have Europe saying it, Australia is saying it, Japan is saying it, Canada is saying it. It's like everybody is saying it. And I was like, how can you guys fight the Feds? It's like, but I get it. I get it because people don't see the technicals. The things that they trusted in, the fundamentals, is out the window, calamity all over the place. All you hear is negative news, negative news. It's like, okay, it doesn't make sense. The market should be dropping. But the smart money, the institutions are saying, no, we are going to be buying because we know where the money is going to go. And my thing is, look, we can see their footprints. We hear that all the time, and everybody wants to do it. But at the end of the day, they lack the confidence in doing it. And this is why that if you train yourself to see the setup, remember the quote I said? Train yourself to see the setup. Those are the ones I give the true credit. So anybody can go back in hindsight. Oh yeah, this is what happened. But ladies and gentlemen, here's that same pattern right here after the financial crisis, ladies and gentlemen. You know what people were saying during that time? Oh, the Feds is making a big mistake. What's the point of even investing in the market when it's all about the Feds? What the Feds are doing is not right. The market is manipulated. Everybody's saying all this stuff, but technical analysis was the only one saying, hey, these guys are buying. It's time to start buying. And people were, and what's sad is that it got to a point where because people were so, not sure, they got upset when they saw the market actually go higher, so that their confusion turned into frustration. But all that could have been avoided by looking at technical analysis. And so here we go. Financial crisis of 2008 started off with the same candlestick signal. Let's go to the dot-com crash. Ladies and gentlemen, guess what? Right here, the dot-com crash. I was in college when all this happened. Dot-com crash. I remember not wanting to get out of college and trying to go for another degree because we heard that, it was hard to get jobs out there. But guess what? The same candlestick signal appeared at the bottom of the dot-com crash. So the fact that this is now happening as we speak, I mean, we just printed another one. And people's like, I don't know. It's like, we are going to miss out. People are going to miss out on this rally. And then when it gets higher, they get upset that they missed out and then they blame everything else. But it's like, wait a second. All it took was for you to understand what technical analysis matters, because there's so many information out there. It's the one that matters that is key. Once you understand the ones that matter, this is why we can be very, very bold in our comments and our statement. We're not saying, oh, let's, it could, all this time when everybody's saying double bottoms. No, we're saying the market is going higher. It's not just on the markets itself. Here's Apple. During that whole drop right here, before Apple made it back to all-time highs, guess what? That same pattern showed up right there. That was what happened in Apple on the monthly chart. This is the monthly chart. So for those of you guys who might be thinking, does this happen on the monthly, weekly, daily? It happens on any time frame, honestly. The only difference is the higher the time frame, the more important that signal is. So here's Apple right before it made all-time highs. I remember in January 2019, I was telling people, buy Apple. It's time to buy Apple. People are like, no, I don't know. This time it's not the same. There's too much competition, da 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 da. And then it went to all-time highs, and people are like, wow, it's $1 trillion company. But the warning signs were there that people either just did not know about or chose to ignore. Here's a company that we're in. This is recent. We started looking for stocks that were showing these same type of patterns once we realized the market was at the bottom. Restoration Hardware, this is a company that Warren Buffett is in. So all these people that are saying, oh, Warren Buffett sold his airline stocks because he knows that this market is down the drain. Yeah, he sold his airline stocks because the airlines were not doing well, but he bought more of companies like this, Restoration Hardware, okay? And now this stock is at all-time highs. It literally hit all-time highs today. And again, it all started with the same bottoms up candlestick signal right here. Ladies and gentlemen, technical analysis is the only thing that I know worked in this market. This company made all-time, well, it didn't make all-time highs, but it made a pretty good, decent move today, right? NIO, supposed to be competing with Tesla. Well, guess what? When nobody was paying attention to this stuff, because now it's all over the news today. I'm getting text messages from people left, oh, take a look at NIO, take a look at NIO. And by the way, one of my pet peeves, by the way, is people who text me after stock has already gone up. I was like, what's the point in you texting me that? How's that going to benefit me? Why didn't you tell me before it was up here? Yesterday and today, I'm getting text messages left and right. Take a look at NIO, take a look at NIO. It's like, why would I need to take a look at NIO? When you should have been texting me was back in March when it showed me that bottoms up candlestick. Are you guys following me with this? That's when I want to get the text. Don't send me a text when it gets up here to $6. And this is where people get into trouble. People get into trouble because now they want to go start buying this stock at $6 because what? It's all on the news. And one of the things I try to challenge people that follow us is, look, try to stay away from the news. Find the stock before it hits the headlines. See, Restoration Hardware, we bought that before it hit the headlines. And my goal is to find stocks that are not making the headlines and hold on to it until it makes the headlines. Okay, if you can find these stocks before they make the headlines, great. But don't come to me after it's already made this big move. It's, oh, take a look at this stock. Where were you back in March when it was showing the setup? I love people that can show me setups. I'm not interested in seeing the results because by the time you see the results, it's already too late. And that's what get a lot of people in trouble. And then they come back and say the stock market is risky, nothing works, and all that kind of stuff. And I think it's just unfair. It really, really is unfair. So here is the S&P 500 on the weekly chart. So I'm zooming in now to a weekly chart just to show you the same process works. The tariff war that we had, on the weekly chart, that was this right here. This is what we saw. And again, I'm not making this up. Anybody can go back and look at this. It's the same pattern. And I don't know if anybody's been paying attention to what happens when we see these bottoms up. They usually do what? They usually, more often than not, will do what? Make all-time highs. All right? Thank you, trader. Okay, all-time highs. Have you guys noticed that? Every single one is like they go back to all-time highs. And so you've seen companies this year already that are making all-time highs. People are like, what? In this economy? That's not fair. Why are these companies making all-time highs? Well, they all had a pattern. People just were not aware of what the pattern was. Look at a company like this. Everybody's talking about this company today. Well, guess what? Back in March, when everybody said, oh, things are down the drain, what did it show us? All-time bottoms of candlestick signal. Okay. PayPal. We are in PayPal. We still are in PayPal. Okay. Why did we get into PayPal? For the same exact reason. when the market was setting up this bottoms, it was like, wait a second, wow. And this is why I said, if you go back to that report that I wrote, let me quickly do this. Go back to that report that I wrote up here. When I said this time, the market is communicating that it is time to cover all short positions. This was on the 27th. Cover all short position, exit all your shorts, and get ready for a what? A rally. Okay, so if you were aware of those things back then, what would have happened is you would have seen and start looking for stocks like these that are now setting themselves up. And so PayPal was one of those. I was like, wow, here we go. Guess where PayPal is today, ladies and gentlemen? You guessed it, all-time highs. Okay, so to say that the market is manipulated, maybe it is. But if you understand when they manipulated it, how they manipulated it, can you benefit from it, right? And that's the whole thing that we're trying to do here, okay? Here's another stock, the SPY recently. It's like, so now we're going down to the daily chart. 3 weeks ago, in the month of May, I was telling people, I said, look, don't get spooked by down days that happens in the market. When you see the market ready to go higher, there are data that will tell you the market is going high. And this is where this is not up to interpretation. You know, I teach my kids, I have a 6-year-old and an 8-year-old. I said, look, anybody can go to this. This is not, well, I think it's a bottoms up candle. It either is or it isn't. Okay. It either is a bottoms up or it's not. Everything we do is a yes or no. If anybody, and this is where I believe technical analysis gets into trouble sometimes, is that certain things are subjective. So like when you say a heads and shoulders pattern, well, it could look like a head and shoulders pattern today, but then maybe, you know, a month from now, 2 months from now, 6 months from now, it's not really a head and shoulders pattern. Same thing as support. Support might look like this area might look like support right now, whereas in the future, well, we find out, oh, it really wasn't support. And so when you learn to see, okay, those type of things kind of makes it difficult. And that's where we try to stay away from this type of stuff and say, look, the ones that no matter what, I could look at this now and I can look at this 100 years from today and you will see that it's the same exact signal, okay? This is not the right side candle, by the way, trader. No, this is not the right side candle. The right side candle is completely different from this one, right? And so the whole idea is, again, when you have technical and the data that we focus on are the data that it doesn't matter whether we see the data today or we see the same data 10 years from today. It's the exact same thing. Okay, the part of technical analysis that makes it tough and I think that misleads a lot of people is the ones where it might look like this today, but 10 years from today, it's not. Okay, so just keep that in mind. Little nugget right there. Anyway, so this is the right side, not the right side, but this is the bottoms up candle right here. And lo and behold, you know, we're not at all-time highs right now. However, this one is going higher. Okay. Would the reverse be the same? Yeah, it's the same thing. I mean, you know, the bullish side and the bearish side is no different. Absolutely. Here's Boeing. It's all on the news today. I just went back. I'm not trading Boeing. I went back. I said, let me take a look at Boeing. Why is Boeing up today? Oh man, lo and behold, guess what we saw back down here? The bottoms up candle. Interesting, right? So I'm not in Boeing. I'm not trading Boeing. It's just this was literally just because Boeing. I saw Boeing on the news today was up today. Excuse me. And so like, let me go see what what the chart showed. And sure enough, there was. You know, you can even go to a 5-minute chart for those of you guys who are more day traders. We don't day trade, so I'm not gonna. This will probably be the only 5-minute chart that I'll show you. But again, even overnight session, that was it right there. Here was the same pattern right here, right before the market went, Boeing went higher. So it's the same thing. Okay. Here's eBay. Okay, eBay, another stock that we had been monitoring. It was on our watch list. This is another stock that we saw during the whole bottoms in the market. Sure enough, you know, we have the bottoms up again, and I'm not sure if it's at all-time highs today. I want to say it is at all-time highs today, but it really doesn't matter if it's not at all-time highs, because how many people would be happy with a trade like this? Okay, and it's kind of interesting, right? Because the whole time this was happening, I was telling people, do not short the market, do not short the market. And I was seeing analyst after analyst, media moguls after media moguls coming out and saying, oh, we're going to hit a double bottom. And I'm saying, no, we're not going to hit a double bottom. We're not going to hit a double bottom. Oh, it's going to go back to that double bottom. And it was funny because then it got to a point where I started watching all these people just to see when are they actually going to change their tune, which is very interesting. I said, I want to see how long they're going to keep this up, because they'll be shocked and say, I wonder if they're going to wait till the market makes all-time highs before they start changing their tune. And I think as of last week, most of them started changing their tune. And it's kind of funny because I was like, well, we never said that you could not, go long in the market. And the worst is the ones that comes back and say, oh yeah, we were saying that we're going to hit double bottom, but we were buying all along. It's like, why would you tell people that we're going to hit a double bottom, the market's going to, the second crash is coming, the second bear market is coming, but then now you're going to come back and say, oh, all along we were buying? It's like, that's misleading, right? That's misleading. So again, this is why we're one-sided. It's either it's going to do it or it's not going to do it. And I believe that, and I've seen some people who, credit to them, they've held to the bearish stance and they still holding on to the bearish stand. And I see people saying, well, I got pied in the face today. I'm losing a lot of money because they're shorting in a market that had already told us it's ready to go higher. Okay. Last one I'm going to show you here is Equifax. This is another stock that we traded to as well. I actually wrote about this in the report. I said, look, again, we had the bottoms up candle down here. Equifax is a credit checking, bureau that everybody knows about. And at the end of the day, it's one of those things where, people can then spin the story behind it and say, well, yeah, there's going to be a lot of people that's going to be running their credit check, and banks are going to have to be doing a lot of that, and maybe that's why it's going up. I don't know for sure, but the one thing I do know is technical analysis through this whole process guided us through that. Okay, so when fundamental analysis failed people, when the economy and the economic data was failing a lot of people, when the old way of analyzing the market was failing a lot of people, the one that kept on going was technical analysis, which is kind of interesting because, even as I look at everything, I said times have changed, right? And it's a lot of people have a hard time believing this. And I get it, everybody wakes up at different times of the day. So I get that. You have people who's like, if you wanted to write a letter right now, back in the day, you used to have to write a handwritten letter. Today, you write letters by emails and text. I remember when text messaging first came out, I said, I'm not writing no message on a text. I'm gonna write a handwritten letter. And what are we doing now today? Sending text all over the place. I remember when you used to travel and you have to stop at the gas station to get a map. You guys remember that? You had to get a map and use that map and you plot it. And I used to be so excited because I was really good at land navigation and all that stuff. I was like, oh yeah, this is where we're going. I could see the whole map and all that kind of stuff. And then GPS came out, and I was like, that takes all the fun away. That make no sense, right? And then look at what's happening now. Everybody cannot drive without that. Remember when Yellow Pages was the place we used to go to find information, right? And now all of a sudden, what do everybody do? Go to Google. I believe it's the same thing when it comes to trading. Fundamental analysis works, okay? Economic data, they're useful, but there's nothing that beats technical analysis, in my opinion, as to the timing and letting you know what the true intentions of the institutions are. The problem I see is people don't know which technical analysis to pay attention to. I get that part, but don't say technical analysis doesn't work. It's just that we don't know which ones work, because the ones we follow, they work. And that's how we were able to see the top before the market crashed, like literally 6 weeks before. And we also saw the bottom when it happened. And we've been taking advantage of this market then. Okay, it shows the behavior of buying, and that's my whole thing. People come to me and they say, oh, well, what about all the fundamental analysis approach? I said, look, to be quite honest, we saw that, look, Hertz going out of business, bankrupt, the technical analysis was there telling you that institutions were selling. The airlines, the Carnival Cruise Lines, all those places were showing that they were doing bad. And so when people come like, oh my gosh, I can't believe oil dropped 50%, the technical analysis was already showing the ones that matter. I keep on saying that because, again, a lot of people don't understand which ones to pay attention to. The ones that matter was saying get away from oil. These things are not ready to go up yet, okay? So long story short, there's so much more I could teach, but here's what I'm gonna do. Oh, by the way, here's what one person said. Wally, I have studied candlesticks to some extent, Your teaching really put rhymes for reason. I can tell you're a born teacher. You found the answer. Far more I could learn on my own. This was an email that I received from somebody earlier this year. Here's another email right here that says, look, Wally, you are the best chartist. Everything that is happening in the market right now, I saw it coming last week because of the video that you have on the VIX. I have a video on the VIX that talk about how to tell when the spikes are beginning to happen in the VIX, so you got to be prepared. And when there's no volatility, and this whole time, I mean, on March 23rd, I even sent a text message. I should have put that in this presentation. I showed a text message on March 23rd. I say the VIX is over. It's like they buying. The fear, like the VIX is going down. Like literally on the 23rd, I said the VIX is going down, guys. It's over. The market is ready to go up. The VIX is going down. The market is going up. And you go back and you find that, look, since then the VIX has been going down and the market has been going up. And so again, this is kind of things that I teach, which I am going to invite you guys to. Thank you, Mills. Mills is saying, hey, I love your presentations. Thank you very much. So what I'm going to do is I'm going to give you my offer because I only have 5 more minutes. If you have any questions, you can type in the questions now, and I'll go over my my offer, and then if I have time, I'll answer those questions. But here's the thing. I've decided to put on a workshop again. I haven't done a workshop in a very long time, but I'm going to put out a workshop this coming Tuesday. And this time, what I'm going to do is I'm going to show you. Now, what you did not see me do is I didn't go into the details of when you find this and all that kind of stuff. So I'm going to put a workshop together on Tuesday night. If you cannot attend this Tuesday night workshop live, you will get the recording. So don't let that stop you from signing up. Make sure you go here to this link right here, rightsidetraining.com/workshop. Okay, rightsidetraining.com/workshop. If you go on there and you sign up, what you'll see is that you'll be able to come in and I'll show you all the ins and outs of this new candlestick that shows you the bottom as well as the others that we have as well. So what are you going to get? Again, Tuesday night, 7:30, how to spot the bullish and bearish setups. We didn't talk about any bearish setups right now. The wins in the house, guys, because timing is everything. I've seen people talking about bear market. They've been saying it for the last 10 years. And then, a broken clock is right at least twice a day. And now that the market is going down, see, I told you it was happening. Some people, I've been saying it for the last year and a half. I've been saying it for the last 2 years. Well, 2 years is a long time to be on the wrong side of the market. With the right type of technical analysis, you can literally see it as it's happening, okay? Within a day or two, no more than a week, you can see what's happening. So we don't have to be sitting down there and like wondering when the next bearish market is going to happen, all right? And exactly like Andre is saying, there's so many rumors out there about the next crash is coming. It's right around the corner. It's right around the corner. Okay, well, the cool thing about it is when it happens, if it happens or when it happens, believe me, we will see it. Just like I told people, when we hit the bottom, we'll see. We saw the bottom the exact day. We wrote about it by the end of that week. Okay, so again, if it's going to happen, we would see it. That's the whole idea. We saw this crash that everybody wasn't really talking about on January 24th. Okay, by February 21st, we already told people this is it. So again, we have full confidence that if you understand the right type of technical analysis to look at, you will see and know what to pay attention to. All right, I'm running out of time, so let me just do this. We'll teach you how to identify false signals, timing your entries, know when to get out, when to place your stop, when not to place a stop on stocks. And also, I'm going to give you access to my software for 30 days. Okay, this software is a software that we have now taken what we teach and what we know, we've programmed it so that the algorithms can do this for you. So you can, just go to the software and say, hey, what is the stock telling us to do today? And it would tell you literally every day, do you need to buy? Do you need to sell? Do you need to just hold off and don't do anything? Do you need to place your stop? Literally one action each day, what you need to do is what it will tell you, okay? So anyways, here is what you will be getting, the modernized candlestick workshop that you have on Tuesday night, access to 30 days of my software, which is $2.99. If you go on our website, you'll have to pay $2.99 for it. We'll also be coming to live weekly webinars for the next month. I'll give you access to that for the next month, every Monday night. And I'll give you my cheat sheet on my candlesticks. Typically, that will cost you $1,494. I'm giving it to you guys a special for $2.99. Now, some of you guys were asking, what about the report? Where do we get the report? So here's what I'm doing. What I'm doing is, if you sign up today, so by June 5th, tomorrow, well, today is the 4th, right? Tomorrow, before midnight, if you sign up before midnight tomorrow, I will give you access, 30 days access to my right side report. It comes out every week, so you get that too as well. But that's only for those who sign up between now and tomorrow night. And in addition to that, to give you that little encouragement, usually that's $147. I'm gonna knock down for those who sign up today before 5 o'clock, before 12 midnight tomorrow. I'll give you access to this whole thing for an additional $100 off. So instead of paying the $299 that you would have paid right here, I'm saying for those who sign up between now and then, you get $199. If you've already signed up for any of my candlestick workshop, go ahead and sign up. We'll talk to you guys and give you some other stuff to kind of help you with that. Okay, so to kind of like you know compensate for the candlestick workshop. But again, I would still want you to come to the candlestick workshop because we have new information that we want to share with everybody. So the VIX course is not part of this, but you can purchase that separately, or maybe if you talk to us, we'll see what we can do for you. Okay, but sign up, guys. $199 today only. By tomorrow midnight, it's off. The $299 is going to be done completely by Sunday. That is my time, ladies and gentlemen. Thank you so much for your interaction. Really appreciate it. Thank you so much, everybody else. Just if you subscribe, just email us. Okay.
All right, well, welcome everyone. I'm Barry Burns with Top Dog Trading, and as I said, we're going to cover Fibonacci today, but we're going to go into a little bit beyond what is typically taught. So this is kind of a quick course in Fibonacci in and of itself that covers a lot of stuff. So we got a lot of stuff to cover, but we're going to just kind of skim the surface of it to show you what's available. Most people think of Fibonacci as Fibonacci retracements, and it is that. But I'm going to show you some advanced techniques today as well. So we'll start with the basics to bring everybody up to speed. I mean, we're going to go really to the basics, and then we'll cover Fibonacci retracements, extensions, and then some other cool stuff that may never have used before, and that I encourage you to try out. By the way, I got to apologize right up front. I dropped the ball. Yes, I did. I did not, and everyone here is going to be upset with me now. I did not come with anything to sell. So I apologize heartily for that. I'm really, 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 really sorry. I just got nothing to sell today. I don't have any products for you. I mean, you can always go to my website and buy stuff, I guess, but I don't have any special offers. I mean, I'm not even going to make an offer at the end of this presentation. So just pure education. Well, you know, I got some free stuff. I'll give you some free stuff at the end. How's that? But no, nothing to buy, just freebies. Okay. So anyway, I'm just here to give you value. So let's do it. All right, a couple house rules. Let's see, there we go. So I'm going to take questions. I mean, if we have time, I'll take questions, but obviously I've got to be done at the top of the hour. So I'll try to leave a little time for questions, but during the presentation, I probably won't be taking any, again, just to make sure we get done on time. It's purely a time management situation to respect everyone's schedules. Please do not trade with any money you cannot afford to lose. All information in this presentation is for educational purposes only. No investment advice given here. Please use this information at your own risk. Trading is extremely risky. Most people do not make any money. In fact, I'll even flip that around and make it sound worse. Most people lose money. That's just the truth. So everybody's inspired now. So how do you become one of the few who do make money? Well, successful trading is a profession. And it begins, I mean, there's a lot to it, but really the core of it is begin with the right mindset. No get rich quick mindsets are allowed here. You will not get rich trading. It is a profession like any other profession that takes time, effort, and serious detailed study. So there's my ugly mug. I've got a really bad bio slide here. I need to update this, but again, I'm Barry Burns, and I'm the author of Trend Trading for Dummies. I've received numerous Reader's Choice Awards from Stocks and Commodities magazine. I've contributed to other people's books. I work with companies like Ninja Trader, Chicago Mercantile Exchange, eSignal, MetaStock, the Eurex Exchange, given presentations for all these different companies and many, many more. If you want my full bio, feel free to go to topdogtrading.com, click on the About Me tab, and you'll see my full bio there, which is like 50 times longer than that. But we're not here to talk about me. We're here to talk about how to make money for you. So the basic concept, just to kind of give people a context for Fibonacci, is this is how most people use it, Fibonacci retracements. So we'll find a move like this. This is called an impulse move. Move from a high to a low in this case. Could be the opposite, low to a high, obviously. And you draw your Fibonacci is a drawing tool. In NinjaTrader, you would click here, but wherever your drawing tools are on your charting platform. And in there, Fibonacci retracement tool is the one you would select. You'd click on the high, pull it down to the low, click again, and it'll draw these horizontal lines here. And these are the numbers that it typically draws. You can usually edit these as well. But this shows you how much, what percentage, I should say, the market has retraced from this low back to the original high. So that's why it's called retracements. From that low, did it retrace 23.6 from the original high? Did it retrace up 38.2? Obviously, if it retraces all the way back to the top, it retraced 100%. So that's your basic thing. And people often use this to look for entry points, to enter in a trend continuation. So they're looking for, okay, how far is this going to retrace until we continue to go down, and they're looking at these as resistance levels. All right, so that's just a quick little intro. Now, let's deep dive into where these numbers came from. So how were they discovered? Well, they're a sequence of numbers named after Leonardo of Pisa, who was known as Fibonacci, which literally means son of Pinocchio. And he introduced the sequence to the West in 1202. But what a lot of people don't know is he was not the first one to discover the sequence. It's been around before he even knew about it. It had been used in India long before that. So what are these Fibonacci numbers? Well, essentially how they're determined. They're mathematical. It's a mathematical sequence. And the sequence, by the way, is up here in the header. You can see it. So you begin with 0 and 1. And then the way you find these numbers is just each subsequent number is the sum of the previous two. So, and by the way, these Fibonacci numbers are not just used in trading. In fact, they're used in a lot of other things way before trading, and then trading adopted it. So, you got 1, 2, 3, 5, 8, 13, 21, 34. Well, how are these calculated? So 1 is calculated because 0 plus 1 equals 1. So like I said, each number is the sum of the previous two. So then you take these two and you add them together, 1 plus 1, and that equals 2. And so that's the next number in the sequence, 2. So far so good. Then you take the last two numbers here in this equation and you add those together. So you got 1 plus 2, and that equals 3. And there's your 3 in the sequence. Alrighty, 1, 2, 3, pretty simple. But now it gets a little different because now we add 2 plus 3, 2 plus 3, and we get 5. So 1, 2, 3, 5. We skip 4. And then they start to expand even further. So now we take the last 3, 3 plus, or the last 2. Take 3 plus 5. 3 plus 5 equals 8. So that becomes the next number in the sequence. 1, 2, 3, 5, 8. And then you guessed it, 5 plus 8 equals 13, and 13 is the next number in the sequence. All right, so that's called the Fibonacci sequence. And everything is rooted in that. So why are Fibonacci numbers considered significant? Well, like I said, they're not really just about trading. Trading adapted them or adopted them from other things in mathematics. They're mathematically very significant. They were found, and they are found, in the structure of many, many natural patterns in, well, the world. They're an organizing principle of nature. So when biologists, for example, would look at the mathematical structure and patterns of various things in nature, they would see these mathematical ratios. Probably the most famous one is the Nautilus shell. And we're not going to go into all of that because we want to talk about trading. So in trading, the sequence is used by some people, most notably W.D. Gann back in the olden days. But these days, most people use the ratios and not the sequence itself. So how are these ratios determined? So each number in the sequence is approximately 1.618 times greater than the preceding number. And that's really the foundation of the ratios. It's called the golden ratio or the golden mean. So pure Fibonacci people in trading, that's really the main number that they're looking for. All right, 1.618 or 0.618. And that is, I know traders who that's all they do. All they do is they trade that ratio. And that's it. They do one thing and that's it. Period, the end. And that's okay. I know one of them personally and he makes money. So, hey, never mess with success. Not gonna argue with them. You don't have to do everything. All you have to do is have one successful trading methodology and you're off to the races. And some people, that's all they ever do. And that's okay. Let other people do other things. So now the other two key ratios, remember the first one, the primary ratio is 1.618 or 618. We'll show you the difference in a minute. But the other two key ratios are then determined by dividing any number in the series by the number 2 places to the right and the number 3 places to the right. So let me show you what I'm talking about here. So we'll put our sequence up here. All right, so 61.8 ratio is found by dividing any number in the sequence that is found one place to the right of it. So what I mean by that, just to be clear, is let's start with 13. So the number 13 in the sequence, if we divide it by one number to the right of it, 13 divided by 21 is 0.619. Now you might say, wait, that's not 618, it's 619. Close enough for government work and evidently close enough for nature too. So, and remember too, in markets, there's always a little bit of noise. So then we take the other one and then we go to the next one, 21 divided by the number one place to the right of it. 21 divided by 34 is 0.71 or 617. 34 divided by the number one place to the right of it in the sequence, and you get 0.618 on the dot. Okay, so that's how the ratios are determined out of the sequence. And mathematicians noticed that there's this common pattern. So it wasn't created that way, but then they notice, oh wow, these ratios kind of interesting. Now there's another ratio, 38.2, that's very consistent, and this can be used in your trading as well for support resistance. So that's found by dividing any number in the sequence that is found 2 places to the right of it. So same concept. If we go back to 13, now we divide it by the number 2 places to the right of it, so 34, and that equals 0.382. Take 21, go 2 places to the right of it, 55, divided by that, 0.381. Take 34, go 2 places to the right of it, divide it by 89, and you get it. All right, now there's another ratio, and you saw it on the retracement chart I showed you, 23.6. Where does that come from? Well, guess what? Pretty consistent. It's found by dividing any number in the sequence that's found 3 places to the right of it. So I'm not going to show a bunch of examples, but just for one, start again with our number 13 in the sequence. 1, 2, 3 places to the right, 55. 13 divided by 55, 238, or 23.6% retracement of an impulse move. Now there's others as well. So we've got our primary one, 61.8, and then we talked about 38.2 and 23.6. They're called secondary Fibonacci ratios, but that's not all. So we've also got 50 and 76.4%. Where do those puppy dogs come from? Well, 50% is not actually a Fibonacci ratio. It's simply been observed that it is a common support resistance level. And there are, again, people in Fibonacci who will say, again, if they're really deep into the study of it, they will say there is a Fibonacci significance to it, and they talk about squaring numbers with relation to this, and that's fine. I don't really care about that, but it is true that it is often a common support resistance ratio, and as a trader, that's all I care about. And then again, 76.4 is not a Fibonacci ratio, but it's simply the mirror of the 23.6. In other words, 100 divided or minus 23.6 is 76.4. Now, again, some Fibonacci purists, they don't use 76.4, they will use 78.6 instead, and that is a more Fibonacci accurate way of looking for a level down there, simply because it's the square root of 618. Whichever one you want to do, it's up to you. God bless you and the horse you rode in on either way. I personally, just through a lot of experience, have found that 76.4 tends to work a little better. It keeps me, it's a more conservative number to look for support resistance. And if you wait for 78.6, sometimes doesn't get there. But they're really, really, really close. Really, really, really close. So this is in the area of market geometry. Okay, so there's a whole study of market geometry, and you can look at Gartley patterns, astrology, squares, and it's all very interesting, can be used very well. But for this presentation, we're just going to use these Fibonacci ratios right here and their extensions. So there they are, 0, 23.6, 38.2, 50, 61.8, 76.4, and 100. So if you want to write those down, fine, but you'll see those numbers on various slides, so you'll see them. Again, here they are. So again, we draw. So first of all, here's our first technique. Now let's go through our trading techniques, okay? Now we're gonna take these ratios and show you how we use them for trading techniques. And I'm gonna show you several. We'll start with the basic, go to the next higher level, and then I got some really advanced stuff for you. So again, the basic one is we start at a swing high, major swing high, by the way, not small ones. And we click on our drawing tool, drag it down to a major swing low, release, and the drawing tool will put in these horizontal lines at the ratios we just showed. And again, remember those ratios mean the market has retraced it off this low to 23.6% of the high, 38.2% of the high, 50% to the high, 61, 76, and 100% back to the high. And we're using these to look for buy-sell levels. And they were pretty good. So this one goes back to 50. Notice, by the way, very important to point this out, it didn't go to 50 to the penny, to the tick, or to the pixel, right? A little bit higher, it's all right. And then it comes back down to 23.6, did not stop. And by the way, on the way up, it didn't stop at 23.6, didn't stop at 38.2, went to 50. So just because these lines are on there, don't expect that, oh, this is where the market has to provide support resistance. Market doesn't have to do anything. So these are support resistance levels, but, well, obviously the market doesn't bounce off every support resistance level. If it did, it could never really go anywhere, could never make any traction and follow through. So we have to look at these support resistance levels in conjunction with other things, primarily the strength of the market move, primarily momentum. Momentum, if the market has a lot of momentum, that's what causes it to slice through any kind of support resistance, whether it's Fibonacci or anything else. When momentum shifts, in other words, the buy, selling, the supply, the demand starts to shift at one of these levels, that's when it's going to hold. So support resistance by itself is not helpful, but it is one piece of evidence that we use in our trading. And it's a very, very, very important piece of evidence. You have to be using these. So here it holds here, this time it holds this one, this time it breaks 50, doesn't stop there, stops at 61.8, goes back to 123, goes almost to 61.8. You can see what I mean by sometimes it's not reaching the level. That's another thing I want you to notice. It's just a few pixels away, but that's still considered resistance there. So these levels are excellent. So that's Fibonacci retracements. That's technique number one. Technique number two, Fibonacci extensions. Fibonacci extensions are different. So with retracements, we were looking for entries on a retracement trend. Fibonacci extensions, we're looking for profits. We're looking for profit targets for exits. So retracements for entries, extensions for exits. All right, so this is a 3-point drawing tool. So again, we go to a swing high, then we go to a swing low, click there, but there's one more click to do on this tool, and we click up here. So when you're going down, when you're looking at a downtrend, let's say that you said, you know what, I'm gonna do a trend retrace here. So you draw it from there to there to there, click, and it will plot these numbers and these levels below you. And these are profit targets. So if you are going short here for a trend continuation, obviously we want it to go down and make a lower low for a trend continuation. And it's giving us potential profit targets. So it's extending. Now the same ratios are used, the same numbers. It's just that now it's below instead of above. So notice that it does come down, boom, 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 stops at 76.4, goes back up to 38.2, and then goes to 100. Now this 100 level is very significant. That is called a measured move, very well known in technical analysis. Measured move, 100%. What that literally mathematically means is that the move from here to there is the same range as the move from that high to that low. And that is a common geometrical pattern that you will see. It's a very, very good profit target to look for. Again, now, which one of these will actually hold the market? Now you do this, say these are potential levels for profits, and then you watch the market. You watch price action, you watch your bar formation, you watch supply demand. Maybe if you're a tape reader, you watch, the level 3 and what's going on there, and the bids and the asks and the fills, and where the big money is coming in, where block trades are coming in. But you got to watch the money flow, because the money flow is what's really happening. Support resistance is potential. Money flow is reality. That's what's really happening. And so you're looking for the confluence of a shift in money flow at one of these levels. Okay, let's look at clusters now. So we can take those last two tools and we can use them together on the same chart and create clusters. Clusters are stronger signals than just Fibonacci retracements or just Fibonacci extensions in isolation. I'll tell you why in a minute. So just to show you what we got here. So we drew a Fibonacci retracement. Now we went from this low, we started from this low, and we went to that high. Retracement back to the low would be 23, 38, 50, and 100% retracement. Okay, then we added also our Fibonacci extension on top of it. Now this time from that low to this high into that low. Then it plots these resistance levels above. But as you know, support can become resistance and resistance can become support. So now we look for, well, where do these lines cluster, where they're really close together? And that becomes an even stronger signal. So right there and all through here, we just consolidate because we get that level and that level pretty close together. So why are these levels stronger? It's not just because, oh, there's two lines there. Ooh, two lines, strong. No, it has nothing to do with two lines. Lines don't make the market move. No lines on your charts do anything. The reason that they're stronger is because you have two groups of traders involved. One group of traders is trading the Fibonacci retracement. They use that tool. Another group of traders, they're trading the Fibonacci extension, and they're looking at those levels. So when you get a cluster of both tools, that means now you have more traders trading off of those levels where they cluster together. And that tends to make them stronger. It's just, mass psychology, human behavior, more people trading off those levels. And that's why they, work in quotes. Okay, so now those are price support resistance levels. And that's what we're normally accustomed to when we talk about support resistance. Horizontal lines showing price support resistance. However, support resistance is not only about price. There are also time support resistance levels. And this is really cool. Now, very few people use this stuff, so I encourage you to try it out, because a chart is a two-dimensional object. Right? Two-dimensional object. We've got price here on the right axis, and then we've got time on the bottom axis, and that's it. So it's kind of crazy to me that so many people pay attention to price, and that's fantastic. Yes, of course you should, but that's not all. You've also got to learn how to read time, because if you leave out the time element on your chart, you are ignoring 50% of the information on that two-dimensional object we call a chart. So, I mean, seriously, how can you have a probability scenario when you ignore 50% of the information? Right away, you're just throwing out 50% of the intel that you got, and it's there. But most people don't use it, most people don't know how to use it, and most people don't teach it. And that's really sad. So I'm going to show you a little bit how to use it today. So Fibonacci time extensions. So again, it's all really kind of the same principle. What we're doing is we're going from a significant low to a significant high. And you can see this diagonal line, identifies the bars that I drew the line from, that low to that high. Now, remember, these are extensions, so they're going to go forward. I mean, they do show you backwards too, but that's hindsight. We can't trade that. So we got to trade as the future. And they're going to draw these lines into the future where these bars have not formed yet when you draw this line. So in the future, what do we've got? Now we've got 123.6, 138.2, 150, 161.8. Extensions are always greater than 100. Retracements are less than 100. But as you can see, the same ratios are used. And so in a way, this is kind of, if you think about it, even maybe more valuable, because you're looking and it's giving you potential time resistance here in the future. And I got to trade in the future. I don't know about you, but my broker insists that I trade into the unknown future. I tried to get him to, let me trade in on historical charts because I can make a lot of money on historical charts. And he says no. Very rude of him, I think. I even took him to lunch and he still said no. That's obnoxious. By the way, if anybody here has a broker who lets you trade historical charts, let me know. I'll sign up with your affiliate link. But I don't think there are any. So we got to know what's going to happen in the future. So we go again. Boom. Now, this is not a price level. This is a time when we can expect a shift in the market. Put in a swing high, swing low, and get another impulse move. Because look, here we just go sideways, just kind of meandering sideways. And here, boom, that's our next impulse move up. At that, what? Time. Now, you might say, but Barry, it's 2 bars off. Yeah, well, again, nothing's going to nail anything to the penny, pip, or tick, to the pixel on your chart. That's asking for a little too much. But it gives us the zone. And by the way, this is an important point. All support resistance levels, I don't care if they're price levels, time levels, Fibonacci, floor trader pivots, whatever kind of support resistance level you use, they are not really literally lines. We draw them as lines in our charts, and that's why it can be a little deceiving. In real life and real market action, there's zones. So there's a little give and take there, about 2 or 3 bars, because, well, the markets are a little noisy. And so technically they're really zones. So once we get toward this line, we're in the zone a little before, a little bit after, when we can expect a shift. Comes back down, boom, again, another time for a shift, up, another time for a shift, down, another time for a shift. Now, let's point out a couple of things just to be totally transparent. Here you see that there is a swing high. No Fibonacci time extension level there. So I point this out because I just like to be very, very, very clear, and you could even point out this one too, that Fibonacci time extensions are not going to tell you where every single swing high and low in the market are going to be. Again, too much to ask. But nothing in trading tells us where every single swing high and low is going to be. So what we do is we just what's called making the market come to you. We've got our trading methodology, we've got our tools, and we just take the trades when our tools tell us to. And if something happens like this, a swing's high or swing low, you can't, I mean, some people say, oh, I missed it. No, you didn't miss it. Your rules didn't tell you to take it. Maybe someone else has a trading system or a rule that told them to take that one. Fine. Let somebody else make some money too. You can't make all the money. Come on, don't be greedy now. Let somebody else make some money. Okay. And you're going to take trades that they didn't take. And it's okay. You trade your rules. You just trade your rules. And that's what we mean by making the market come to you. You've got your high probability trade rule set. And when it's met, you trade. When it's not, you don't. The market's going to do all kinds of crazy stuff. All right. Now, here's a really cool one. This is one of my favorites. So this is called the Fibonacci time and price tool. And what's actually called in most trading platforms is Fibonacci circles or Fibonacci arcs. And what they do is they measure both time and price combined in one tool. So as you see here, it curves. And so that's why they call it an arc. However, if you were actually to scale back on your chart, you would see that if you scaled to a small enough scale or a big enough scale, whichever way it is, and you could see a lot of history, you would see it's actually a big circle. But what's visible on your chart is an arc. So that's why there's two names for it. So it measures, notice how it changed as you follow this. It's moving in time, going right, going right, going right, going right, but it's also going up and up and up, and therefore measuring price. And what we do is we look for it to break the arc, bam. Come back to the next arc, bam. Again, did it find this one? Nope, that's all right. Let your neighbor catch that one. Pay for his kid's college education. And this one pays for your kids, okay? Or whatever you want. All right, so now one little quick warning here, one little tip. When you're using any tool that measures time, and especially time and price together, like the Fibonacci arcs and Fibonacci circles, you've got to use a set scale. You cannot change the scale. Once you draw this on your charts, if you change the scaling of your charts, it's going to mess everything up. You'll say, hey, wait a minute, my arcs are moving. And yeah, they will move. And that's why you can't do it. So you got to set your scale and not change it. Otherwise, the lines move all over the place. Now, as I said, I'm going to go through this last part real quickly here, but it's very important. Support resistance levels such as Fibonacci, very important. But what we really have to do is at every time we get into one of those levels to determine whether or not that level will hold, we've got to look at the energy of money flow of price action. So what I do is I look for 5 energies of money flow. Number 1 is trend, and I use a moving average for that. Number 2 is momentum. Number 3 is cycles. I use an oscillator for that, a timing tool. And number 4 is support resistance, and that's where Fibonacci fits into my methodology. It fits in step number 4. And then number 5 is the fractal energy, and that just means I'm looking at a higher time frame. So this is what I do. This is how I trade. My methodology is called the 5 energy methodology. And we do it in this order. It's literally a checklist. Step 1, what's the trend? And are we early in the trend? Number 2, is there strength behind that trend to make it follow through? Number 3, I've got a cycle indicator that I'll be happy to give you the cycle indicator if you want it. And this times my entries with precision. And I look for those cycle highs and cycle lows to come in at support or resistance. And then I confirm it with the next higher time frame before I'll take the trade. So what I do is I just, at each potential entry point that I'm considering, I just ask myself one question. How many of those 5 energies are aligned bullish or bearish? Give it a score of 1 to 5. The higher the score, obviously, the higher the probability. I kind of liken this to taking each trade to court. In other words, we need 5 independent witnesses to establish a preponderance of the evidence. So the key to these 5 energies of money flow is that each one is uncorrelated to the other 4. That's what gives you a probability scenario. So again, just a real quick summary here of my 5 energy methodology. Energy number 1 is trend. I just use the 50 SMA for that. Simple. I don't use any proprietary indicators. You don't need any special software to use my methodology. Works on any charting platform. So that's it. Now, does that help you a lot? A little bit, but you can't use it alone. So then what do we do? Well, some people say higher highs and higher lows are a trend, or lower highs and lower lows, but no, it's not. That's just a complex retrace in an overall uptrend. Trend is actually defined by the dictionary as to extend in a general direction. So a trend is a long-term move, not a short-term move. That's just a complex retrace. Trend is not defined by higher highs, higher lows, or lower highs, lower lows. Then we can look at energy number 2, because momentum, or I'm sorry, trends, the trend's your friend until it ends. Well, when is it going to continue? When is it going to end? It just tells you direction at any snapshot in time. So we got to add momentum, because that tells us whether a trend will follow through or not, and when it will end. So we're going up, 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 up. But wait a minute, higher high on price, awesome. 50 MA is up, awesome. But now here's our momentum indicator, and momentum makes a lower low and a lower high. Here's a little extra distinction for you too. Lots of people look for divergences of highs. Yeah, that's okay. Again, that's one piece of evidence, not enough to trade with. Here's an extra piece of evidence. Look for the lower low as well. Even though it's in an uptrend, look for there to be a lower low on momentum and a lower high. That's a much stronger divergence pattern. And then that's the end of the trend. That's all she wrote. And you see that before you see it in price action. And you see it before the turn in the 50 MA. So momentum is kind of your leading indicator. It's the undercurrent of the ocean that you don't see. You see the waves, like trend waves, see that on the top of the surface of the ocean. Momentum is what's happening underneath the undercurrent. Same thing here. Here we've got a little bit of a higher high, pretty much equal highs, but momentum is showing you a momentum shift underneath the money flow, and down she goes. Energy 4 is my cycle indicator. Again, I'll be happy to give this to you for free. And it's just measuring when, it's a timing indicator. Again, timing, when your highs, when your lows are going to come in. So it doesn't give you the range of the market. Momentum gives you the range. So trend gives you direction. Momentum gives you the range. How far will it go? And cycles gives you the timing as to when to enter and when to exit. And then finally, support resistance. We've talked about that already, so I won't go into that anymore, but here's a Fibonacci example where it went to 50. And just to show you, so here's our momentum indicator. Here's our trend indicator, 50 MA. So price gets above the 50 MA, but the 50 MA is still down. So technically, we're still in a downtrend. We hit a cluster of resistance. Remember, we talked about clusters. What's the cluster? In this case, it's that swing high. That's a resistance level for the future. And the Fibonacci, or the 50% retracement level. So now we got 2 groups of people. People are trading the 50% retrace. People are trading that last swing high. We got a cycle high. Momentum to the upside is very, very low. See, when we went down, it was big, big momentum down. Had a higher low on momentum. By the way, higher high on momentum too from there. Higher high, higher low on momentum. That ended that move temporarily, ABC complex retrace, until she goes back down. And finally, the fractal energy refers to the next higher time frame. And so now we got the 5 energies aligned. Trend is down, holds the black line's the 15 EMA, cycle high, momentum stays below 0, and we look over here at momentum, and it's going down on the higher time frame. That is a 5 out of 5 score, and I'll take that every day of the week. In fact, I do. So the method's very robust and adaptable. It works for any market, any time frame. I trade this personally on stocks, commodities, options, currencies, futures. You can do this for investing, swing trading, day trading. I use the exact same method because Again, all we're doing is looking at the energy of the money flow of the market, any market, whatever market you put on a chart, and relative to whatever time interval you set that chart to. So all the indicators are just math functions, and they're empty. And you fill those math functions with the data from whatever market you trade relative to whatever time frame you're trading. And then the data goes in there, and therefore the indicators adjust to it. And so it is a universal trading method. So that's it. I got, like I said, nothing to sell you, but I got some free stuff for you. So what I like to do is actually help people make money before they spend any money. So what I'm going to do for you today is give you my free trade, one of my free trade strategies called the rubber band trade. The reason I give this one away for free is because, well, it's just been consistent for years and years and years and years and years, decades actually. And it's a simple trade. I can teach it to you in 26 minutes. In fact, that's what I do. I've got a video for you, 26-minute video. And I teach you the setup, and it's simple. And another reason I give it away for free is because it has a super high win-loss ratio. And I know that most traders psychologically need a very, very high win-loss ratio in order to be able to follow through with things and stay encouraged. So that's it. Now it comes as part of a free course, a little mini course I got for you, 5 little videos. The video course is called Make Money by Breaking Every Trading Rule You Ever Learned. So I'll show you in here how a lot of what you've learned about technical analysis is wrong now. It's not that it was always wrong. The problem is that traditional technical analysis doesn't work anymore. You know, the Bible of so-called modern technical analysis was written in the 1940s. Well, that was before computers. That was before algos. That was before high frequency trading. Markets don't work that way anymore. Chart patterns are different now because of all the technology. So anyway, I'll tell you what, here's what works in today's markets. 5 20-minute video tutorials, get some quizzes at the end just to give you feedback loops, make sure you understood everything. And I'll even invite you to another free webinar. And it's at that free webinar that I will give you my cycle indicator, which really is just a modification of an indicator that's already in your charts. So you can use this on any charting platform. But this cycle indicator is one of the best things I ever created. It nails swing highs and swing lows. And the real practical benefit of that is it helps you stop getting stopped out. So you just go to this link right here, and you can see it there, www.rubberbandtrade.com. Easy to remember name. And go there, get it free. Just sign in and you'll get access to the course. And that's my gift to you. So that's all I got for you. I don't know if we have time for any questions, but if so, I'll let Anna kind of guide me on that. And if so, great. And if not, well, that's okay too.
Yep, we have time for a few questions, sure.
Okay, very good. All right, anybody got a question you want to type in? And you know what I'm going to do? I'm going to type in my email also, since we only have a couple minutes. So if you have any questions afterwards that we don't get to, feel free to send me an email at barry@topdogtrading.com. There it is, barry@topdogtrading.com. All right, so let's see here. Oops, I got to scroll down. No wonder I'm not seeing any. My things at the top. Okay. Let's see here. Oh, you missed most of the presentation. Okay, well, sorry about that. I don't have any set time to do this particular presentation again right now. It's not on my schedule. But I don't know. Anna, are going to be recordings of this?
Yeah, sure.
Okay, great. So yeah, go through Anna and you can get the recording. Just InvestorExpos. Andreas says, I didn't miss a word and it was great. Well, that's awesome. Thank you very much. John, what is the best way to determine the trading volume? Just the volume histogram at the bottom of your chart. You know, that's the actual volume down there, and that's the best way to, you know, instead of going through an indicator. There's good volume indicators too, but hey, you know, just look at volume directly. And I see one more here. Oh, in the end, I would like to ask you, who is the good unexpensive option trader? Who is the good? I'm not quite sure what do you, of the presenters here today. I'm not quite sure. I'm sorry, not quite sure. Okay, that's all that I'm seeing. So I just want to thank all of you for attending today and for participating in the presentation today. I want to thank InvestorExpos. I want to thank Michael and Anna, obviously, and you guys are just always awesome and always put on a tremendous presentation. So thank you for inviting me to be a part of it. It was my honor and I really enjoyed it.
Thanks so much to everyone who attended today's show. Don't miss our next event on June 18th. Follow us on Instagram to find out more about our upcoming events. This session was recorded and recording will be sent to your email. Just in case if you didn't get the recording, simply go to your YouTube, type in InvestorExpos, and here you will be able to find the recording from today's event and the previous ones. Once again, thanks so much to everyone and happy trading!